Good afternoon. Thank you so much for joining us today. I'm your host, Sherry, for your Traders Exclusive webinar. We're going to be talking about beating the markets with proven strategies, and today's presenters are Larry Gaines, Toni Hansen, Alla Peters, and Norman Hallett. And I know it's going to be a great webinar. So please check out our website, tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you find a recording of today's webinar. Over the next couple of days, you'll instantly get a replay link after it's over because you did sign up to go to webinar. And before we get started, I'd like to share a quick disclaimer. You guys pretty much know this is standard issue. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. So please take notes and make sure you got a little context with it and write them down, because we want you to hold your questions until after the speaker is done. And that way we don't interrupt their presentation. And right now I'm going to hand over the mic to Larry Gaines of Power Cycle Trading. He's going to be talking to us about how to trade uncertain markets, low risk with high return option strategies is kind of an alternate title. Larry has been involved in trading and brokering commodities and financial markets for over 30 years. He started his career trading tanker cargoes of foreign crude oil for a leading New York Stock Exchange oil company in the early 80s. How exciting would that be? And quickly advanced his career to become an executive vice president of one of the largest international oil trading companies in the world. He started trading options in 1987 on cargoes of crude oil, and in 2010 he started a trading educational company to teach option trading based on his directional trading model and option strategies designed to provide high returns on low defined risk. So Larry, I'm really glad that you're here with us. I'm going to find you and make you the presenter. And you should be able to unmute yourself now.
Oh, okay. Well, thank you. Let me get my screen
Excellent.
here.
All right, great.
Oh, wait a second here.
I see a blue screen and I see a bunch of graphs below. There we go. Tilting the trading odds in your favor.
All right. Well, let's get started. Appreciate everybody being here today. Let me make sure I've got everything set up properly. 1 second. Just give me a second here. I'm trying to get my kind of screen organized. There we go. One second.
Isn't that how it always goes? You think you're ready and then something doesn't act the way it should?
I've got it set. Okay, anyway, yeah, I can see what the difference is. Yeah. All right, well, let's get started. Appreciate everybody being here today. And so what we're going to talk about are some really two great option strategies that really work in any kind of market environment, but are especially exceptional when you're getting into kind of more uncertain market environments and higher extreme volatility. And so these are two really low risk, high return strategies that I like to kind of fall back on. And they're the butterfly and long condor. So let's get started. So the following presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice. It should not be construed as a recommendation. Now, to me, the secret to trading profits come down to three things: direction, timing, and then risk management. And I like to use options for that. And with the combination of these three elements or components to your trading, you've got more advantages to making successful trades. So when you're, trading options, you have so many more advantages than just trading stocks. But as you probably know, it's a bit more complicated as well. But once you understand the benefits and the advantages of options and option spreads, you're never going to look back. You're not going to want to trade anything else. Now, when used correctly, option spreads are going to provide you defined trading risks, lower capital at risk, greater trading leverage, and they're going to be giving you an unmatched hedging advantage if you use the right strategies. Now, I've been trading options for over 30 years and have found that the most valuable go-to option strategies that can literally help any trader out there more than any other is knowing, and especially during times of extreme market uncertainty, is knowing how to use the option butterfly and the long condor. So they're kind of my trading secret weapon. Now, the huge advantage that these two strategies offer is their unique option framework that's kind of designed to take advantage of time decay, theta, and volatility, which are the two main option pricing components. Now, when you stack these together, it creates, better trading odds for your trades that you're putting on. They're more tilted in your favor, and they can be used in any type of market environment. So it becomes a really favorite strategy, especially when we get into the uncertain market environments, when one different headline can upset the momentum of your trade and, put you in a position that was a good position into a losing position. So these two types of option strategies are perfect for that. Now, because they are structured to require an only small amount of your hard-earned capital, it really, puts less stress on your trades because you've got less capital at risk. And that's always a major win-win situation for you as a trader. So number one is you're, reducing your capital at risk on each and every trade. And that really helps you, your confidence of your trades and becomes less stressful for your trading in general. Now, when we look at the butterflies and long condors, they're very dynamic and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade the butterflies and long condor, and you're going to be covered for both the offense and defense of your trade. So goals and protection, or profits and hedging. Now, they can also work regardless of market direction. So, markets trade in cycles up, down, or sideways, and these types of strategies can be incorporated in any types of market cycles like this. So they can provide you income from the stock that is going nowhere, really helps eliminate that stress of having to be perfect on a stock's direction or overall market direction. It eliminates the time decay expense that you're going to encounter if you're just constantly only buying long options, and it's going to help to really take the unsettling guesswork out of your trading. So they can be structured for a very low cost or capital at risk, and they can be structured to offer you trading returns of 10 to 1 or higher, which you'll see, a few examples here today on that. Now, the butterflies and the condors, or long condors, they're very flexible, as you'll see today. And once you learn the fundamental setup, you can then adapt these option strategies for both your goals and your market insight. So they can be constructed to be more kind of delta neutral for sideways markets. But to me, the real beauty is that they can be used for your directional trades. So they can be structured to offer you either a bullish or bearish exposure to the market when you feel really confident about a certain direction. But if you're wrong, then the butterfly and long condor is going to really help you to keep that risk low, but at the same time, potentially giving you the potential for big returns. So that's the big winning advantages of these strategies. Now, let's be real though, these types of option spreads are not going to give you that unlimited profit potential, such as if you just go long calls, but they're usually going to cost you a lot less than if you buy outrights, and they're going to offer you an amazing risk to reward trade setup. So when you look at the butterfly option spread, for one thing, it's going to offer you the biggest return on your capital at risk of any option strategy there is. And I'll show you some examples of that. But the long condor is also just a fantastic one because it's a structured trade that gives you a bigger profit zone, but it also leaves your risk low and provides great returns. So, this is kind of really what it's all about in trading. Now, when we look at the butterfly and long condor, these are fantastic for hedging. So when you mess something up, now you can use this as your kind of fast, low-cost way to cover your what pronto when a position starts to move against you. And I found no better hedging strategy out there, period, than using either the butterfly or long condor. So, when you look at a trade that you might put on, a lot of times you'll put that trade on and, it looks great. And then all of a sudden a headline comes out, or the Fed FOMC meeting, and everybody gets the jitters, and so the momentum or something stalls. So you can use these two strategies for a fantastic way to hedge a core position. So by constructing either a butterfly or long condor around a strike that is under pressure from another core trade setup, like let's say you had a credit spread on or a debit spread, this can become one of the best ways, or is the best way I found, to immediately neutralize and lower that risk. Now, if you've ever done credit spreads, you probably had that ugly trade setup where everything's going great on all your credit spreads, and then you have that one trade where the option where the price actually goes through your short strike of your credit spread. And this is what one strategy that's the best and probably the only way I've found that you can actually hedge a credit spread, and that's by using what we call the butterfly hedge. And so this was kind of a really nice feedback from one of my members after she learned this. She said, "Wish I'd known how to do this hedging before I lost so much money doing credit spreads." And that is so true. If you've done credit spreads, you'll know the feeling. Now, when we look at the hedging aspect of these two strategies, what it does is it helps you keep your original position open by just either implementing the butterfly or long condor hedge on that original position. So what it does, this strategy takes advantage of that time decay component of the spread. And so a lot of times, you have a trade that goes against you, stalls out, and you don't know what to do. Maybe you stop yourself out, and then all of a sudden the trade comes back and it's a winner. So what I found is by either using the condor or butterfly hedge around a core trade, what it can do is it can buy you time. So a lot of times all you need is that the market to settle down a little bit, and by having that time selling component of the spread, that's going to take advantage of time decay, and you're basically getting paid while you wait for that your initial trade to maybe stabilize. And once it does, you can just take your hedge off, lift your hedge, and go for the original trade in that direction. But a lot of times, though, you're going to also then reduce the cost of that trade from the time decay and getting that time decay element from the selling component of the spread. So here's the basics of when we look at the butterflies. So this would be like a call. You could do calls or puts, and we'll go through a lot of examples here in a minute. But so let's say you're long a call here and short a call. You've got a call debit spread, and you've got your risk here of $300 per spread. So that's your debit cost. But I always try to teach my members and clients, we would never want to lose our full capital at risk. So rather than stopping this out, if we needed to, we could easily convert this to a butterfly quickly, reducing this initial risk of $300 by adding a credit spread to this structure. So by doing that, we can reduce the risk and still have a potential for a big gain. So all we would need to do is sell a bear call credit spread in this example. So we could sell a call here, buy a call here, bring in $200, reducing our risk now down to only $100. And what we've done is we've created a balanced butterfly. All right, so it looks kind of like a tent. We call it the butterfly. This is kind of what we call the profit zone or the tent. And when you get to the top of that zone or profit point, that's that expiration. If you hold it into that, and that would be your maximum profit. But the main thing here, though, it reduces your risk in this example to $100. And then you can kind of kick back and see if the market's going to stabilize. And then you can either leave this trade as it is for a potential return if it goes out inside your profit zone, or you can lift your long call hedge or short call hedge and go in either direction. But it gives you a lot of the flexibility for your trades. And a lot of times that's all you need is just a little time for that trade to stabilize and let you decide what's the next move. So that's really important in your trading sometimes, just to kind of kick back, see what the market's going to do, and then you've got still the option to do a lot of different things. Now, the long condor is very similar to the butterfly. And the thing I love about this structure is that we can widen out our profit zone. Okay, so instead of having a butterfly where we're selling the same short strike as your debit spread side, you've got kind of a tighter needle to thread to get that big maximum potential profit. But when we do the long condor structure, what we want to do is widen out that next part of the trade, the credit spread side, to give us a bigger zone of profit. So usually when I'm hedging, I usually go to the long Condor first, and then if I need to, I can kind of roll down and convert to a butterfly or something, or add additional legs. So it's a really great option to have in your trading, to be able to understand and how to use these two types of vertical spreads to, to hedge or to lower your risk for any directional trades. Now, the core concept that make the butterfly and the long Condor dynamic really comes down to, again, understanding, how option pricing works, and the concept of time decay, or theta, and the effect that it has on the price of the option. So let's take a review to kind of get you on the same page here as to how this works. Now, when we look at theta, this tells us how much an option price will go down over time. So it's the rate of time decay of a stock's option. And time decay occurs because the extrinsic value, or that time value of your option, is going to go down each and every day, and it's going to accelerate as expiration gets nearer and nearer, and at expiration it goes to zero. So that's what we're taking advantage of, is this pricing component of time decay, and also then implied volatility. And those two pricing components will go to zero at expiration. And since a butterfly or condor has a selling component, we're basically selling time and volatility to take advantage of that kind of decay. Now let's take a look, and I'll go through some examples here in a minute of a bunch of different structures and the benefits that they give you. But here's a place for us to kind of start, so you can get a general concept of how these work. Now let's say, for example, we've got that famous XYZ company. It's at $45. And based on our trading model or whatever we're looking at for direction, we're looking for the price to move down to $43. Not a very big move, but a move to 43. So I just kind of want to show you how this works. So first off, though, when I'm looking at any trade setup, always have a target price in mind on any trade before you even take it. So in this trade, we're looking for a potential move to $43. So that's typically when I do a butterfly, I typically make your target price the body of the butterfly. All right, so here's the body. Now what this means is that we're going to buy, in this example, a 44 put, okay, and that's going to cost $238 or $238, and then we're going to sell against that the 43 put, okay, and then we're going to sell against it again. We're going to sell another 43 put and buy the 42 put. So this just created a butterfly, and the body is at that short strike of your butterfly. So that's why it's called a butterfly, and the body of the butterfly, and then your wings are the long side of the trade. So this is a put butterflies for a downside move. Now, when you add up everything here, that your debit cost of $238 for the 44 put, the $1.06 for the 42 put, and then you net out the credit you brought in from selling those two 43 puts at $1.67, you can see that your cost of this trade is down to $10 per option spread, or per butterfly spread. So that's the beauty of it. Now you've got a risk here of only $10 on this trade. So if everything goes wrong and you can't adjust it or do any additional defending, that's the most you could lose. Now your profit, though, is you're taking your strike price, your difference in your strikes. Okay, so the 44 minus the 43, that's $1 wide, or the 43, 42, that's $1 wide. So our middle strike, or less lower strike, gives you that, and then less your debit cost. So 43 minus 42 less your cost of the trade, 10 cents, would give you a potential profit of 90 cents times 100 to convert it to an option spread, or option contract. So your potential theoretical profit here is $90. Now, $90 on $10 of risk, that's a 900% return, or you're risking $1 to make $9. So that's the real beauty of these kind of strategies, is that you can see if you're in a really uncertain market environment where the littlest headline change can really mess up your trade, you can really control your risk based on the structure, but still have potential for big, huge return on your capital that you're risking. So the next thing is, though, how do you choose the best butterfly or condor strategy to kind of match your trading goals? Now, one major goal of every trader, in my opinion, should be that you look to select your trades based on what's going to provide you the most consistent positive return, over time, with low defined risk and not always that greatest return or home run. So, in trading, I kind of compare it to kind of chipping away, you're hitting singles and doubles, and then occasionally you'll hit that, big home run. But you want to be kind of consistent on your equity curve, and these kind of trade strategies can offer you that. Now, one of the best ways then to achieve this kind of awareness of what is out there and available to you is to understand what different option strategies there are, how they work, and then select the ones that's going to be best suited for the market environment you're trading and your specific trading goals. So, everybody here today will have a different amount of capital to trade. One, you might have 10,000 or you might have 100,000 or more. So it can make a big difference on your trading outcome or your goals that you're looking at. But one thing you'll find is that you can use these two strategies for any size trading account. It could be a $5,000 account to a big hedge fund, and they work regardless. And so they can really take a small account and help you build a more consistent positive equity curve, turning that small account into a larger account. So that's the great thing about it, keeping your capital under control. And the first thing that I look at on any trade before it's ever taken is I look at the risk first, and then I look at the return on that risk. So a lot of traders tend to do it the other way around. To me, I'd rather see what my risk is, define that, and see if if that's something that I can live with. And then I'll look at the return, and if the return on that risk is good, then take the trade. So let's take a look at the different variations of the butterfly. I kind of call this the butterfly family. So you've got a number of variations. You've got the long call or put butterfly. You've got what we call the broken wing, sometimes called the skip strike butterfly. You could use calls or puts. You've got what I call kind of the ninja butterfly, which is an unbalanced ratio butterfly. You've got the iron butterfly, and then you've got another category, hedging. So defensive, hedging type trades using the butterfly. And then we've got another kind of an offshoot of the butterfly, which is the long condor option spread. So let's go through some of these, and you'll see, get a better idea of how they work. So first, let's take a look at the butterfly. Now, the other thing with the butterfly, you can adjust the risk and your profit based on the wingspan of the butterfly. So if you think about it, if you're collecting butterflies, if anybody out here does that, then how's the easiest way to catch a butterfly? It's with a big, huge net, right? Versus a small net. But with the option butterfly strategy, then we can kind of compare it to this kind of example. By making a wide wing butterfly really wide, we get a bigger profit zone or bigger net to catch profits versus if we have a narrow profit zone. All right, but the narrow butterfly will give you super low risk, and if you do nail it, into an expiration, a lot of times we call these the lotto trade. You can make huge return on that very small risk. But if we want to kind of have a bigger zone, then we can really widen out that butterfly spread, and the cost of the capital of that trade is still going to be less than usually any other type of strategy you might do. So let's say maybe you go long calls. Your risk can be huge, but this is going to define the risk but still give you a big return. So we'll look at a lot of different examples here so you can get an idea of how this works and kind of be a big benefit to you. So the first one we'll look at is a narrow wing butterfly, okay? And this is going to be like $100 wide spread, or dollar wide, or 100 for for an option contract. Now remember, if you trade options, one contract is equivalent to like trade 100 shares. So that's how we convert it and look at the price. But in this example, we're looking at SPY. And SPY, the ETFs are fantastic for butterflies. The ETFs and the index options are great for butterflies and condors. So, like the SPY, QQQ, the IWM, or the SPX or NDX, they're great for these types of strategies. Now, in this trade setup, I always look at price targets also first. I've got kind of what I call a 7-step process, and one of the steps is to always have a target in mind. So we've had SPY sold off hard. We came back, and we're trading towards this 618 retracement. It's going to be right here at 273. So this was going to be the target for the butterfly. And I also look at option activity. There's a lot of activity here as well. So it gave us a great potential target, but wanted to keep the trade super low. So we structured this as a narrow wing butterfly. So in this example, bought the 272 call, sold the 273. So if you look at that and break it down, that's a call debit spread, and then sold the 273 call and bought the 274. There's your bear call credit spread. So we just made a narrow wing butterfly $1 wide, okay? 72, 73, 74. So you can see the spreads between each strike is $1. So that would be like $100. The cost of this trade, though, to put it on is 10 cents, $10 debit. Okay, so that's $10. So your potential theoretical profit, if you went out and nailed it perfectly at expiration at your body of 273 on that risk of $10, your profit's $90. That would be like a 900% return. So you're risking $1 to make 9. Now you'll never ever get exactly that potential, that return of exactly, in this example, $90. There's always a little bit of leeway that you can't quite grab it all. But the thing is, if you can take a little bit of that, so this one actually made 70, that's a huge return. So if you were just looking, somebody said, hey, I just made 700% return in 1 day or 2 days or a week on some trade, you might think they're lying, but that's the realistic outcome for these types of trades. So here you make 70 bucks on the risk of 10. You can see, well, yeah, that's a 700% return. So that's the thing that's pretty amazing. And a lot of times I call these the amazing option butterfly. Now here's the profit zone, and here's what it looked like going out on your risk profile on the analytics on Thinkorswim. So it was going out right here at expiration on the 16th, which was the day of expiration. So these can be set up for short duration trades. Typically I like to go out, you know, you can go 1 or 2 days out, or typically maybe 7 or 8 days, or at the most maybe 2 weeks out, because we're taking advantage of the time decay, which starts to accelerate. You know, in a 30-day life cycle of an option, it really starts to accelerate after it gets in the last 30 days. And then so the weeklies make it a perfect kind of strategy. So it's going out right here, almost right where we wanted it to, 273.08. So you can see here it went from a 10-cent debit on that spread, the butterfly, to 80 cents, or that would be $10 to $80. And then that's your profit of $70 per butterfly spread on that risk of 10, 700% return in this example, 2 days. So in this trade example, we had 4 contracts, and that's 280 bucks. Now on those 4 contracts, if it went straight down or straight up and you missed the profit, well, your maximum risk then was going to be $40. So, you know, you can live with kind of that kind of risk on a trade, and that's what makes it great for uncertain markets. So we're taking advantage of the time decay and also volatility collapse, and giving you a potential high return on that very low capital at risk. So again, with option pricing, time goes to 0 and volatility goes to 0 at expiration. So that's how these can really work and pay off for you. So that's a really narrow wing butterfly. So let's take some other examples here, some wider wing butterflies. So here's one again on SPY for a short trade. Now in this market, it's been hard up until recently. It's been very hard to short, because, you know, you'll get that sell-off and then you have these really fast snapbacks. So what we've been doing for any short trade is usually doing it with a butterfly. So here's a $500 wide spread. So again, trading here was using SPY. We were shorting that, and it was trading at 392, and we're targeting down here to this 390, and then down to this kind of potentially 287, 286 area in here. All right, so price target around at 387. So what we did was a put butterfly using puts for a downside move. So we bought the 390 put, sold the 385, and then sold the 385, bought the 380. So you can see it's $5 wide spread. So $5, that'd be 500 per option contract. Look at the cost of the trade now. So we just set up a short trade for maximum potential risk of 50 cents here, which is $50. That would give us potential profit of 450. That would be a 900% return if at expiration this was to go out at 385. But we're just looking for taking profit on a short, and we're just going to get out when we get into our zone just to take some out on that trade, because just from the realistic standpoint of shorting, it doesn't tend to kind of stay in there too often. Now in this trade then, we made $86 per spread, okay, 2 days later. And if you look at that, 86 on a 50 at risk, that's 172% return. So again, we're keeping our risk super low, but giving us potential to make some big returns on that risk. So it's going out right here. You can see the profit zone. So it's very, very kind of flat, but right inside of that. And all that area in here is still potential profit. But we were just looking to make this wide enough to take a move down and take some money out of this market as it went down. So this went from 50 cents to 136 or 136, and there's your profit of $86 per spread. So if you did 1, that's 86. If you did 10, that's 860, and that's a 172% return. Now here's the other big advantage too. So this is how you can play some of the big guys like Amazon or Tesla's, the really high expensive high flyers. So this is doing a butterfly for a long trade on Amazon. So $300 wide spread or $3,000. So we were looking for a move up here directionally from Amazon, targeting like this 3,200, 3,220 right in here. See that price action support right in there. So we wanted to do a low risk trade to do that. And if you trade Amazon, you might not be able to because it's so expensive. So for example, if you were trying to buy 100 shares of Amazon here and it was trading at $3,150, you have to fork out $350,000 for that 100 shares, okay? And if you did get that target, hit it at that 3,200, then you would have made $50 per share or 2.33%, but on a huge amount of risk. So we could do the same trade though with this butterfly and can do the same trade, and instead of costing us $315,000, this trade was going to cost for one option contract, equivalent 100 shares, that'd be $388. Okay, so that's a huge advantage. So we're going to target the same target, 3220 here, but we're going to do this then 3190 long call, 3220, and then the 3250. So that's $30 spread width, which is $3,000. The total cost is $388. Potential theoretical profits $2,612. 673% return if you nailed it. But we're not looking to nail it. We just want to get in there and take some profit. Okay, but it gives us an opportunity to do that on very, very low risk. And that's the thing I look at first. So here's the outcome. So it was going out here at expiration, right here at 3210, right there. Okay, not perfect, but good enough. And so this went from 388, the debit cost here, and it was going out right at that point in time at 1426. So that gives you a profit then of the difference. That's your profit of $1,138 per option contract. And that on that risk of 388 is a 267% return. So instead of going out and forking out over $315,000 and making 2.33, you could have done a butterfly and come out of the trade with that a low amount of risk, $1,000 per spread, and that would be a 267% return. So you could have done, one contract or 10 contracts or 100, and you can see what the difference would be. Here's another great example to show you another advantage, and this again is on Amazon, and do it $1 wide or $1,000, $10 wide or $1,000. So again, we were looking for a target price up here to 1830, and it was trading at 1782. Now again, here if you bought 100 shares at 1782, that's over 178,000, and if you hit your target of 1830, you made $48 per share or 2.69. But in this example, I'm going to show you a couple big advantages here on this example. Here, your cost is only $80 on the spread. Okay, so $80 or 80 cents or $80, that's your maximum at risk. So 1,000 minus 80, so theoretically you might make 920, so over 1,000% return. But here's the beauty of it. So here it is at expiration on the 6th, on a Friday, and this is in the AM, about 9:30, 10 in the morning. So this trade was trading, it was trading right here, so right on the edge of that tent, but into the profit zone. So you can see here it went from $80 or 80 cents to 230. So that is a profit then of $150 per butterfly spread on the risk of 80. That's a 187% return, but it gets better. So here's in the morning, and here 4 or 5 hours later in the afternoon, this has gone up by 4 times, 400, another up to 600% return. Okay, so it's gone up 4x just within the same day, just a few hours later. So here's the next point to show you. So now it's trading right here, still pretty close. It's trading at 1832, but now this has gone from $80.80 to $695, and that's $614 profit per spread, or 4 times more than what you would have made earlier, and that's a return of over 700%. So that's in the same day, that difference, and that's because it's taking advantage going out at expiration, sucking out that time and implied volatility. Now here's an example of a long Condor, and these are great for reduced risk type directional trades plus hedging. So here's just a way we're trading Boeing, and it was going all over the place. So we wanted to set up a directional trade though on this kind of a breakout here. So set this up using a long call Condor and did it with super low risk. So it was traded at 204, and we were looking for a move up here to 215, 220. So we did a Condor, and you can leg into these, or we just did this as a spread, but look at the risk, $65 risk. That's the risk of the trade total. And we've got though this big profit zone here, okay? So this is basically combining a call debit spread with the vertical credit spread, but a widening out of that profit zone there. So this was going out, potential max profit would be $185 if we get out at expiration between the two short strikes of the spread, and that would be a 285% return. But we were trading right here, so just went ahead and took the profit. That was set this up on the 3rd, and that was on the 9th. It was trading right here at 215.12 right there. And so that was not a bad profit. We were up $106 per spread on that risk of 65. So that's 163% return on one spread. All right, so that's a really great example there. So you can see the risk profile here. So maximum loss 65, maximum profit 185. Now, here's another example of how great these can be for hedging. Now, this is taking opportunistic hedging, what we call it, because this is going to convert a trade into a free trade. So here it is trading SPY again at right here, trading at about 275. We're looking for a move back down here to 270. So when you're trading, and especially in options, always think 1 or 2 steps ahead. So we were thinking, okay, what if we got the move down that we're looking for, and it goes down to around that 270? Could we convert this to a free trade by converting it to butterfly or condor? So I'm looking at that potential step. So this starts out with the put debit spread 273.70, maximum risk 65, not too bad. Potential profit 235 if at expiration it closes, below that 270, but it typically doesn't. So what we did was when it washed out and pushed down to that 270, we looked to see if we could convert it to a free trade, and we could. So we sold the 268 put, bought the 265, brought in a credit of $65. Now what that does is that offsets or cancels out the debit cost of the original put debit spread, and now we have a free trade. So we had the original 273, 270 put debit spread at 65 cost. When it washed out to the downside around 270, we were able to sell the 268, 265 bull put credit spread, brought in $65, gave us a zero risk trade with the potential to make $300. Now it went out, we took profit right here. It's trading at that 271.33, so it took 164 out of the trade. Now trade 1, when it washed down to our target, closed out partial amount of that at that 270 area, and that made $98 per spread, or 150% return, not too bad. But the second part of the trade made 164 and on zero risk. So that's the thing that's so amazing or fantastic about these two strategies. You can trade these markets that can be insanely volatile or uncertain, or some big high price stock, and you can do it for much less, but still have potential for big, huge returns on your risk involved. So if you'd like to learn more on how to master these kind of high reward, low risk, option strategies that can work for you in any market, 2 things you can do now if you'd like. I mean, hopefully you got enough information here today to kind of take action now, figure it all out. But if you need some help, I've got a great offer for you. And this is a butterfly course that I just did in February. So all new, and it's 100% on just the butterfly and long condor option strategy. So if you can put this link in there for everybody, Sherry, I appreciate it. Just send that to everybody. They should be able to just click on it, and then you can, you can use that. And I can't send it to everybody here, but if you could send that, then I've got this package, $97, but this will be my course that I did in February. It's a 7-hour course on the butterfly and the long condor. All right, not only will you get the course, but you're going to get all these bonuses. So you'll get, this is all recorded, broken down in 30-minute modules or less. It's yours forever, the course, the recordings of the course, plus the PowerPoint manual. So you'll get all this, and it's yours, forever. But you're also going to get my new options for beginners course. So even if you're starting out, this is a great package to get you started because it's only $97. Plus, this is invaluable as far as these two strategies. So you'll get my options beginners course and my options beginners program. So you get those two benefits. We'll do a live follow-up Q&A. You'll get a link to that. So, and that will be recorded. You'll get my option trading tutorial, another option course on the Greeks and probabilities, my option strategy manifesto, 15 different option strategies, my power tool guide. This is a printout to give you the Greeks, and you'll get a trial membership to my club that you can start whenever you want. You don't have to start right away. If you don't want to start it tomorrow, if you buy this package, send us an email. We'll start it whenever you'd like. But that gives you access to my trading room, all my Q&As, and a lot of other benefits. So here's the course here. Again, I did this in February, 7+ hour course, easy to view, 30-minute modules or less on kind of breaking the course down into chapters, 456-page training manual, which is the entire PowerPoint. My courses are very detailed with a lot of trading examples to show you how these different trades work. Part 1 is going through the Greeks, theta decay, volatility, option pricing, using Fibonacci for your target analysis, how that works, and then the core basics. Most traders just don't understand the concept, so it kind of demystifies the trade for you there. And then how, why, and when. I go through each of these different variations of the butterfly with trade examples step by step so you can understand how they can work. So the long collar put butterfly, wide wing butterfly, broken wing butterfly, ratio butterflies, broken wing ratio, iron butterfly, vacation, long condor, and more. So it's a very, very thorough course. Now, the other part of the course too that's really interesting is the monthly expiration pinning part of the course. So when we get into monthly expiration, which is we're currently in this week, so it comes 12 times a year basically, these can be fantastic trades. And in the course, we'll teach you how to price target where a potential strike could go out, or the pin for the monthly, and then how to do that using option activity and Fibonacci, and then how to set up a butterfly at that target. And then we get into the Condor part of the course, kind of having to speed up here. I'm almost out of time, but then part 3, we spend a big chunk of the course time on hedging. So first start with the progression of hedging. What that is taking you through all the different hedges. If you're long a stock, how you can hedge that. If you're long an option, call or supplement or put, how to hedge. Then we go into hedging using the butterfly long condor to hedge a core position. And then I go into how to use that butterfly or condor to hedge vertical spreads, either vertical debit or credit spread. So execution management, when to put on, when to take off. And then you get a resources chapter of what is assignment risk, expiration risk, auto exercise, how that works. And you get a 58-page library of trades done in the past, so you can go back and look at the different trade setups on the butterfly or long condor. So really a fantastic course, very popular course. And here's just a little bit of input from Alicia last go around in Feb. I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like this. Wish I'd found you sooner, but glad I found you now. Thanks again for your time. So that's about it. Here's the bonus package. You get my option trading for beginners. This is a brand new course that I did. So this is about a 2-hour course on beginning option strategies, how options work. Then a beginning option program for you, study package here, 4-hour course there to kind of help you get rolling. And then follow-up Q&A, which will be live and recorded. My option trading tutorial on the Greeks, standard deviation, option probabilities. And then here you get my 15 strategy guide. So if you don't know what a back ratio spread is, or iron butterfly, or short strangle straddle, you get that. My power tool Greek guides, print that out, put on your desk. And my 1 trial membership free month to my trading club. So you get access to my trading room every day, video newsletter every night after the close, Q&As every Tuesday, recorded and live, and discounts on all courses and software on my website. So wow. A lot of information there, but hopefully you guys and gals sign up, and I look forward to working with you in the future. So use that link. Hopefully, Sherry, you can send that out, and I appreciate
I put that link up a couple of times.
Okay,
and
great.
I've
Thank you,
also
sir.
asked everybody if they have questions for you, they're going to need to email you because we are out of time, but I really appreciate you coming in with us today.
Thank you very
Is
much.
there an email address that they can get to you, or do you want them to just go to that link?
Yeah, just go to that link, and then you can follow it from there.
Okay.
Thank
All right,
you so
Larry,
much.
thank you. That was awesome. Appreciate it very,
Thank
very
you.
much. All
Bye-bye.
right. Bye-bye. I'm going to come back to me. I want you guys to know that if you have to leave early, we will send out a link because you did register. And you can also access these webinars in the future at tradersexclusive.com/archived_webinars. And when you get there, you just click over here on the right-hand side of the screen. And then you can actually go here. It tells you when the next webinars are coming up. And then click here to get to all of the, oops. I cleared that out, didn't I? All right, well, my next guest is ready, and I appreciate her being up in here. And it's Toni Hansen of Trading Finance Group with Avoiding Traps. And Toni, I'm going to go ahead and make you the presenter since I killed my slideshow there, and you can get set up.
Oh yeah, you guys, hopefully you can hear me now.
I can hear you. I just want to finish introducing you. You're going to be bringing Avoiding Traps. And Toni is one of the most respected technical analysts and traders in the industry with a high reputation for accuracy in both bull and bear markets. Her style of trading and market analysis transcends both time and market vehicles, making it attractive to investors and traders of stocks, futures, options, ETFs, commodities, and Forex. She's a popular columnist on TheStreet.com's Real Money Pro and Alan Farley's The Hard Right Edge. And she is also the author of 4 books, including the award-winning Simple Steps to Trading Discipline. Thank you for joining us, and take it away.
All right, thank you for having me. So hopefully y'all see my PowerPoint okay right now. I'm actually going to be doing something a little bit different this time. I am going to be focusing a lot on just showing you guys the concepts that I'm talking about, but using the live market and what we're seeing going on in the markets right now. So my topic today, you guys, is avoiding traps and basically how to have the upper hand in the market. You know, traps in the market, these are scenarios or situations where we get into a position, we're looking at something where we have like a primary directional bias. So maybe you want to go long, you know, you're looking at the long side of the market, things look great, but you're not quite sure on your timing yet. Is it quite time to get into that trade, or do you need to give it a little bit more time? And what happens if you're off and you get flushed out of the position? So those flushes are often what we consider to be called a trap. So a really good example, for instance, would be, let me grab my pen here, choose my pen color. So let's say you are looking to go and buy a breakout, and you get these nice pullbacks, and it's kind of going into a range, and you go and you see a break happening, you put your order on, you get filled, maybe you're looking at the trading range that's going on here, and you think, okay, you know what, great, I'm going to put my stop here. Well, pops up, goes like that, and then takes off again, just to trap those balls, get them stuck under there and flush them out, or trap the bears rather, and get the bears trapped under there, but also flush out the bulls too. So your bulls are getting trapped up here, and your bears are getting trapped down here. And in the end, anyone taking that entire channel break really isn't looking so good or feeling so good at the moment. So one of the things that we're going to look at today is how to avoid a breakout like this. How do we know if that breakout is too early, or is that the one that really gets going? Is that the one that is going to take off? And there's a lot of different types of traps that occur. I'm on a brand new type of PowerPoint that I've not used before, so bear with me here, you guys. You're kind of like my test subject here on this. Let me clear this here. And the first thing that I want to do is talk about knowing our trend. There we go. That came up really fast, but we got it. Okay, so when we're looking at trends, there's different types of trend action that's happening. We have trends that are going to give us these impulse wave moves, and I'm going to talk about these here in a second, versus trends that are going to be more in congestion type of zones. An impulse move, you guys, this is a very, very important concept in the market. It's actually the first one that I teach anybody that wants to get into trading and learn to trade under me, because without understanding the impulse moves, you're not going to have a good idea of where you should be getting into setups. So one of the main first things that we will do is we will see traders get stuck because their timing is completely off based on an impulse move. They might see an uptrend that's in place, just a series of higher highs and higher lows, and wonder, hey, you know what? Can I still get into this trend? Or is this trend so far gone that if I buy it, I'm just going to get stuck and it's going to turn around and flush, or I'm not going to have really good return compared to what my risk is. And that's going to be another problem that traders are going to run into. They'll get into something, it might go a little bit in the direction, and then it ends up flushing and turning back around on them because they got in at the wrong level. And it might still go and play around more up at those highs. I'm on kind of a wide monitor, you guys, so if you can't see where I'm drawing, let the moderators know and they can let me know so I can move my drawings over as well. So let me show you, and we're first going to start by taking a look at what these impulse waves are and how those can trigger traps and how we can use that knowledge to avoid one specific type of trap. And that is basically getting in when your trend is too exhausted. So for that, I'm going to go and I'm going to flip on over here to my charts. And I'm going to start by just showing you guys a chart of the micro Nasdaq. Here we go. I'll move this down, make sure you guys can all see the screen okay. So this is a 4,000 tick chart. If you guys can't read that, we're on a 4,000 tick chart. The program that I'm using, this is NinjaTrader. You can see I've got some fib extension levels on there, but I'll take those off for the moment. So an impulse move, you guys, is just these primary directional movements that are happening. So we had the really big impulse move that happened as we were going into the end of the day on Monday. Oops, excuse that. There we go. But we also have smaller impulse moves. So basically, any impulse move is a primary directional trend move where the momentum is average to stronger than average. So what does that mean? When you're looking at momentum, this is like our primary force in the markets. What we're doing is we're examining how fast is a move taking place compared to other directional trend moves that have taken place in the past. So if I show you, for example, a little bit of a larger time frame chart, like say the 40,000 tick chart here. You can see I've got some fib levels on here. Again, I'll show you guys this here a little bit later. But what we're seeing here is this is that impulse wave I was showing you on the 4,000 tick chart. what makes this an impulse wave is that the momentum of this move is average to stronger than average compared to a lot of the back and forth movements that have happened in the past. So usually in an average move, you're going to have these upward swings, and then they'll be punctuated, or these up bars will have like these bigger bars, and then they'll kind of go back to a lot more overlap, and then you'll have some bigger bars and more overlap. And that's what a pretty average trend move is going to look like. Stronger than average isn't going to have as much of that overlap. It's going to have more of those larger bars taking place, like you can see over here. Let me see if I can get my tool a little bit wider. I don't think it's going to let me do that. Nope. Oh, well. I'll change the highlighter color. That will make it a little better. Oh, it's not going to let me change highlighter color either. All right. Well, sorry, guys. I'll just have to draw over it a couple of times so you can see everything clearly. So what we're looking at are these movements that are taking place in the market where we have this average to stronger than average momentum. So the thing with everything in the market is it's all fractal in nature, meaning that you're going to have impulse moves on smaller time frames and you're going to have impulse moves on larger time frames. When we're looking at these impulse moves in the market, what we want to do is we want to take a look at, hey, what's happening with the current move that might be taking place, and how large is that move with that momentum that is going on? How large is that compared to where we see the same momentum happening in the past? How far were those previous moves, sorry about that one, previous moves able to go before they needed a break or they needed a rest? And this is even a bigger one right here. So that can give us an idea of how far that current move can go before it's going to need a break or it's going to need a rest to catch its breath as well. So if you look at this as it was going into the end of the day the other day, we had, or well, actually it was going into noon the other day, we had it forming an impulse move that was pretty similar to a lot of the momentum moves that happened in the past that had that same momentum going for them. So notice that size of that move. And that is a very, very important trait or characteristic that can help you avoid traps, because you might be looking to go in the direction of that trend, looking to play that trend. Well, if you look at impulse moves in the past and you find that, hey, I'm in the upper quarter of the size of what a lot of those previous impulse moves are already, well, the chance is going to be much more slim that you're going to have a really good continuation pattern. Now, there can be exceptions when you have larger impulse moves as well, such as this one. So you might go into like a little pause and then get a continuation. But either way, it gives you a heads up to warn you about those levels. And the larger the time frames you go up, you're going to get those more extreme impulse levels. So you'll find times where you'll be on like a 40,000 tick chart. You'll look back over like the last couple of weeks or so, and you might not see any other impulse move that is as large as the one that you are currently seeing. And that means you need to drop back and you need to go up to a larger time frame. So if you're only seeing like one down move and one up move, for example, this 40,000 tick chart, that's only giving us like a micro view of what is happening in the trend on this micro NQ. So we can have a good idea of what the size of those smaller impulse moves are, but we might not know how far can this bigger potential impulse move go. So we can be prepared for short-term corrections, but we might not know if that short-term correction is going to turn out to be a bigger, larger term correction. So for that, I'm going to clear this here. we need to go up and take a look at some of those larger charts. So for example, our 40,000 tick chart, we can go and flip and take a look at like a 240-minute chart. And what you'll see on that is more of those larger impulse waves to kind of put into perspective the move that we were seeing and how that move really compares to previous impulse waves. And you'll see that there's plenty of impulse waves that are actually larger, that have the same momentum. But what you'll notice is even as we're looking at those larger ones, the biggest portion of that momentum move, when the momentum is the same, is going to be about the same size. The ones that have slightly bigger or stronger momentum are going to be slightly bigger. If it has, slightly slower momentum, it could be a little bit smaller. But they're all pretty close back and forth. And you'll see there tends to be a tendency in terms of the corrective ones too. What's an average corrective move? Even just beginning off of a brand new high, where might your first zone of potential support be? And those counter trend moves are going to be very, very typical in terms of how they compare one to another. And this is where the concept of measured moves and such come into play. So you guys will see that discussed a lot as well. Especially when you're looking at target levels. So let's say you've got like a breakout strategy, for example. Typical main target level on a breakout strategy where if the momentum on that breakout is comparable to the momentum of the impulse move before the correction or congestion, then that measured move is a very, very high probability target, you guys. But it has to be measured momentum. So this has to be at the same pace of upside momentum as compared to here to have that highest probability of it doing a pause right at this level. And we don't know if this momentum is stronger than average. We call this a widening up zone. It can start to create reversal patterns at that spot. It can go into a longer base and continue. It can go into a little bit of a better correction. You don't know just based upon the measured move by itself. That determination goes into what's going on a bigger picture. But if you are on a smaller time frame, let's say this is like a 60-minute chart, okay? And you see a 5-minute buy pattern right here that is happening intraday. It might be a beautiful buy setup on that smaller 5-minute time frame. But if this is your 60-minute chart, what this is showing me is that, hey, we're in that upper third to upper quarter of that comparable impulse move. So my risk on that is that it might not get going as fast. The momentum could start to shift at this point. I could get a lot more of that back and forth action happening. Even if it ultimately hits that 100% extension, it could still start to go back and forth. And that often can happen as early as the 76.4% extension. So you might get a 76.4% extension compared to this move. It stalls in there, pulls back, ultimately makes it to the 100%, but it could start to do a lot more of that chop back and forth before it fully gets there. So that tells me, oh, well, I could buy it, but I maybe need to just scalp it. And my odds of really strong, nice, continued follow through aren't going to be nearly as good as if I saw a really nice 5-minute setup down here. Because not only do I have that 5-minute pattern working in my favor and being able to go to like a measured move on that 5-minute chart, but I would also have that entire move over here to help get me going and give me a much bigger target level. So that's where these impulse moves are coming into play. And by the way, since I'm talking about this, one of the other trap situations you guys are going to run into, and this happens a lot after hours in the indices, but it also happens a ton in stocks, especially in stocks intraday that are trading under 200,000 shares a day. You will get this base and you'll be looking for that base for a breakout, right? But if you get to a base where you are seeing that all of the bars look kind of like this in that base, and you're not getting a lot of really solid back and forth movement compared to your upside move, that also has a higher probability of doing a trap, flushing up, coming back down. So if you took the buy, it'll break under your lows, flush you out, and then can go after that spot. So if this is a super narrow range in here, that is a very high risk situation because you have a much better chance of it doing a false breakout on you. Let me go and see if I can show you an example of that. Or at least a spot where such a thing would be likely to happen. In the futures market, we could probably see it on like a really small time frame chart. We had the Fed here come out, so might get things kind of not wanting to work as well because this is just my teaching computer. So hold on one second here. See if I can get this to go to a smaller time frame for us. No, bad timing, Fed. All right, let me check and see if I got another chart here. I can show you guys this one. I might have to grab an image from my trading computer to show you guys. But here's GameStop. Let me clear this. I'm going to show you GameStop here in a minute too. So I don't see any like super tight ranges on this. So what you see here is, notice this 800 tick chart. See how you've got a lot of the back and forth action? Well, that is better because then when you do get a break, like you can see over here, you're not as likely to have a false breakout. But if your range is really tight, then you got more of a chance that, let's say, for example, here in this section, again, we can see back and forth movement. So this is really good for a breakout. But let's say each of these bars is not having much for tails, and you just have kind of one green bar, one red bar, one low, one high, you know, kind of going back and forth like that. Then you run a greater chance that this could pop up to here, pull back in before it tries to go, and it could even come back down here before it tries to go and flush you out. So let's say, for example, on this, that your range was about half of what it was. So you're looking at just like those smaller bars, and that's all the bigger your range is on your trading channel there. So in a case like that, that trap has a much higher probability of happening, where you'll get stuck in it, buying the breakout, then you'll get pulled back in here before it fully goes. So one of the things that we can do to help avoid that is to recognize that situation to begin with. Also, look for setups where your range actually has back and forth movement within it so that you get that kind of swinging going on within it. You can see up here, for example, this is a symmetrical triangle example, but you've got the swinging back and forth. When we're looking at a really tight, narrow range too, you also might get like a breakout that looks like it's going to be good, but it doubles out. So it doesn't get to that measured impulse move. So you might be looking for a target up here and it just can't quite get to it. Momentum might be good. Shoot, momentum might even be stronger than that first impulse move. But it just can't go. And this is a big risk that a lot of traders make, because when that range is really, really tight, they might keep their stops under that low only for it to be flushed out right before it goes and takes off. So if something has really extreme momentum, but it doesn't just do like a pause and continuation, it starts to go and end up pausing more than like half of what that previous channel is, it's probably going to go for a measured time development. So notice this other measured move thing, right? We've got the measured impulse waves, but then we also have measured time development, which is really important. So it could double that and then go again, but that means that this low might flush out your previous low there. So that knowledge alone can help you out as well when you're dealing with your trade management. Now, one thing that's nice with this breakout here is that if you go back and you look at the congestion here from our breakdown, this is technically called an avalanche pattern, then this is the same amount of time development, which is really favorable because it tells us that compared to a similar impulse move here to here, this was able to continue after doing a correction that lasted this amount of time. So it lasts the same amount of time, so it has a higher probability that it's going to go and offer a continuation, and it's not going to be a trap. Let me show you, there's other really great examples of this time development on GameStop here too, just from like today. So if we're looking over here, for example, I'm going to go to a 1 minute time frame, actually, show you the 1 minute time frame. This is another thing that we can use to help us avoid some traps too. So here we have this with our GameStop coming up off the low. You get nice, strong momentum move here, and then we get a correction. Volume is dropping, which is really good because that's telling us there's not really a whole lot of sellers coming on board. And we have a break higher again. So let's say you're looking for this to try to continue with that uptrend. So what we want to see here is looking at this time development, taking that time development and applying it to the next correction. So when you get a good little shift in momentum, we've got an inverse head and shoulders here, and I'm going to talk about that again in a minute here too. That goes and gives us a really good zone for a buy to try to get that continuation going. In a really strong setup where you've got this low forming like this isn't going to stall here. It might give you the measured move, but since this is in a lower level, you actually want this to go, do only a little pause, and continue right away. So the fact that this goes out longer is actually a bad thing. So when you get the same time development twice in a row, that's good for a buy setup, but it won't necessarily guarantee how far that goes. You still have to watch the momentum and the size of those impulse moves. Here, it corrects the same amount of time again, but this time it's the third time in a row that happened. So compared to the past corrections, if they are the second in a row, great. It can still keep that trend going. If it's the third in a row, it's more likely to have a substantially harder time. And even though you also have an inverse head and shoulders here, it can't get going. It's going to struggle. So you also want to look at, hey, this move up, this entire move up, how does that compare on the larger time frames as far as impulse moves go? Is that a typical impulse move by itself? And that can give you an idea that this is going to be due for an exhaustion and a stall at this level. Another move, I know I've got I tell people, you guys, I could talk for like days and days and days and still not tell you everything going through my head as far as teaching you guys stuff, because I like to just go over things over and over and again so that they get kind of like drilled in. But I'm going to go back here and we're going to talk about the time development aspect again in terms of avoiding traps. And this can come into play when you're looking at setups like inverse head and shoulders or head and shoulders or breakdowns. So I'm going to widen this up and show you another way that you can avoid a trap and how to time it better. So in one of our nice continuation patterns, I gotta get this to slow down on me there. One of my favorite continuation patterns is when I see an inverse head and shoulders within a zone of congestion. So the congestion is that secondary type of trend I was talking about. You've got your nice uptrend. Notice some comparable congestion periods here. It congests the same amount of time again, but then it can't go because now it's the third time in a row. But then we go into that bigger correction. So we have a nice, beautiful two-wave correction here. Hits a low, hits a low. So this is where we can start to use time development again as a tool that can give us a pro for our setup. So if I go up here and I pull up Fibonacci time extensions, I can go from that first low to the last low. And what I know is that in an inverse head and shoulders, your best setup is often going to take place right around that 200%, or you could call it a 100% extension. That's going to be the typical zone that we would see an inverse head and shoulders trigger. Now, we do have a couple of other things to look at. We have this time development here, 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 all of those past ones where the time development's all the same. So what that does is that puts us out closer to here, which is going into the close. So this zone then becomes the main trigger zone for that shoulder. Because of the closing bell, we had a little bit of an extra flush though. We didn't actually see that trigger happen. But when it gapped in the morning, that's confirmation because we have that time development with the shoulders. And then we even have the time development with the corrections. And there's a little baby inverse head and shoulders going on in there. It's just we get the flush because of the close. That wouldn't happen so much if it was like an intraday thing. So again, same thing over here, head and shoulders. Same time development here to here to here. Nice, beautiful two-wave trigger. Two-wave pullback in here. This congestion, again, overall similar to a lot of other zones that we have congestion, and the breakout. Now in this case, we don't have the immediate follow through. In a really good head and shoulders, here's the smaller impulse moves. That tells me, okay, first resistance level is here because that's what that other impulse move action is showing me to be very, very common as far as the size goes. So I wouldn't want to take a buy setup here. I see so many traders that will do that because there's too much risk that you're going to get stuck. Even if, hey, yeah, it's a great channel breakout. Sure, it triggered the head and shoulders, the inverse head and shoulders. It's also more likely to be a trap because if you look at that impulse move right here, it's too far compared to the previous one. So if you wait again for a similar time correction, you have a better chance of timing your entry really well. And then if, momentum's not playing out as you like, you can go and manage it and still manage gains even if you use trailing stops because you didn't get trapped right here. This doesn't become like a bigger stop where you hardly have any gains at this point. So if something doesn't follow through, when it goes and it hits that measured move, but it does it with substantially slower momentum, you can protect those gains and not worry about those corrections or those pullbacks. And we have a really good example too of the inverse head and shoulders on the Nasdaq that just triggered as we were going into our Fed, and I was hoping I'd have a chance for this to hold off. Well, shoot, you guys, it's not going to pull up for me. But if you guys go look at the 3,000 tick chart of the Nasdaq, you're going to find that same thing happened. I should have done a reboot on my chart before we got going. But anyways, these are just a couple of the main ways that traps can happen, and there are lots of ways that the market likes to trap you, but I've shown you 3 ways that you can avoid these traps and you can have really good timing as far as getting into your trades. You can also use things like Fibonacci Fans to help you with your trading as well. So for example, the reversal that took place going overnight into today on the Nasdaq on the downside, it was coming off of some really good Fibonacci fan levels. Let me see if I can. This is a problem I run into sometimes on this computer with my GoToWebinar. It's kind of stuck sometimes. I have too much data running in because I've got several monitors on this. Let's see if I can get this to come up on another one for you. Here's the 30-second chart. And let's see, those are all GameStop. All right, I'm going to put this 30-second chart and I'm going to make this the 3,000 so you guys can see that. So give it just a second here. And I'll show you the time development that I was using on this. So I was actually expecting a buy as we were going into this. If you look at the time development again, look at that, you guys. See how that time development is playing out? This trigger here is right in lines with how long it took a lot of those previous corrections to do. This one was double. So then you've got that whole double. But the timing on that is perfect as far as the time development went. Ignore volume on this because we're on a tick chart. And it's not quite as active as the micro is going to be. So you might actually even want to do like a 1,000 tick chart for this. But if I go and I show you the time development on this, check out our time development zone for that inverse head and shoulders. It's between the 161.8 and then the 238.2. So you're right in that zone again, that kind of sweet spot zone for your inverse head and shoulders. If this had a shoulder that was before the 161.8, I wouldn't want to take it as a buy. It's not going to be as good. It's going to be more likely that it's going to be a trap. If it was after the 238.2 before it got going, if it couldn't get going until after that 238.2 and then it tries to do the shoulder over there, that's too late. That's really bad. So it's more likely that it's going to be a trap. So you've got that sweet spot zone where close to 200% is the best, but it can give you a little bit of room on either side of that. Let me put this on like a smaller chart here so you can see it on the Nasdaq a little bit better. And you might find your timing to be a little bit more perfect on the micros versus the E-minis. There's a little bit of a difference between the two. So a lot of times I'll use the two to offer confirmation so that they both are working together for me. So here, what we have is that this even goes and it's giving you a little bit of another inverse head and shoulders here. Problem is, when it goes to do the neckline, it goes to a higher high in the neckline. I actually was teaching about this here today, earlier, but this still puts this right smack in the sweet spot for where you would be wanting to look for your buy setups at. So you're looking at this time correction here, overall to here. You're looking at the shorter ones there, and then you're looking at the timing between that as well. If you had a typical two-wave correction instead of an inverse head and shoulders, it's going to line up better with that 200% right there. So the fact that we went out a little bit later has more to do with this being an inverse head and shoulders within this pullback. Whereas if it was just like a two-wave correction, like that, you'd be more likely to go right smack at that 200%. And so that can tell you, hey, am I too early, like right here? Am I trying to buy that too early and then get flushed out, hence trapped? Or am I too late? And in this case, there wasn't a situation of it being too late. You would have just had that potential for it to be too early there. All right, you guys, let me go ahead and I have so much more I can teach you, but we don't have the time. So I'm going to go ahead and hope you took lots of notes. I know that they recorded this. We are right at time development for this to try to push a little bit again. But this is a really good example of these impulse moves, you guys. Look at those impulse moves there. Those big moves, the impulse moves. Hold on here. Go over here. And what I want to share with you guys, my offer for you guys is something that I've never offered until just this past month. I've made it a couple of times in a couple of the classes I've done. It's my market timing bootcamp, which is 6 weeks on demand. Each class, so each week is about 2 hours. So you got a massive course here. It includes my playbook, which is all of my core strategies, my textbook, which is hundreds of pages, and access to my forward focus and my League of Traders forum, which is where we chat about trades throughout the day, and we kind of goof off a little bit too, you guys. So you'll see other traders in here. And we'll be talking about specific strategies and things like that, and that's throughout the entire day. So this entire boot camp here is something that I'm making available to you guys here for $250. It is $399 on my website, but I've also included my second boot camp, which is my 3 strategies using Fibonacci. And this basically points to every time in a trend. So it has strategies where it starts out with strategies that are at the very beginning of the trend, the middle of a trend, and then strategies at the end of the trend. All of these are lifetime access. So you probably got about a good 30 to 40 hours of classes here. And it's all for $250. You guys also get access to my League of Traders forum, you guys, where again, you can chat. You'll get Trade Tracker Pro for NinjaTrader, which is a plugin that allows you to use your Fibonacci fans and arcs if you use arcs. But you'll see me mostly use fans to help with the time development and again, avoid a lot of traps. Your Fibonacci fans are an awesome tool for doing that. So the 3 strategies using Fibonacci goes through pinpoint. It goes through basically my core system of market analysis, and then it goes through 3 very specific strategies that apply to different times of the market. So again, beginning of a new trend, how to recognize it, middle of a trend, and then pure pivot trading at the end of the trends as well. So, you know, showing you an example of that, you guys, I'll show you a trade here. you'll see me and my traders catch the same trades, but I'm not telling them when to take the trades. I'm teaching them how to take the trades. So this is one of those examples of the trades. The red is the short. This is one that she caught, and I caught this as well. And so you'll see examples of this. This is one of those reversal strategies that is shown in that course. Then let me see here. The market timing boot camp is my core main course. So this is going to take you from like the very beginning of everything. So you get to know how I break down the market, how it goes into things like trends development, time development, volume, and how to read volume in the market. It goes through some of the different indicators that I use, and of course about a dozen or so strategies as well. And it's very, very complete, you guys. So you get all of this for $250, and you can pick it up at www.tonihansen.com/beginners. So let me post that in there for you guys on your.
I put that up there for you. When you started showing
Oh,
those slides, I put
awesome.
it up there.
You are right on the ball.
We're going to have to call our time, though. This is
Yep.
so much.
I know.
I
I'm telling you, I
appreciate
could
with
keep
us.
going.
I mean, hey, I might put together a ladies' day. Maybe we'll do something with just girls on one time, and maybe just have a couple of speakers. Would you be up for that?
That would be awesome. I'd love to do that.
Okay. All right. Well, then I will see what I can do.
All right.
So thank you. Thank you for joining us. And everybody take advantage of
You're
this
welcome.
offer. And I hope everybody's ready for our next person. Hey, have a great day, Toni.
Yeah, take care, everyone.
Thank you. All right. Now I want to remind everybody that if you have to leave early, we do have our replay going up at tradersexclusive.com. There's a ton of other stuff there for you to see. Our next speaker is Alla Peters of Fibonacci Trading Institute with how to trade institutional reversals with confidence using Alpha Fibonacci system. Alla is the founder of Fibonacci Trading Institute, proprietary Alpha Fibonacci system, Fibonacci Trading YouTube channel, and Fibonacci Trading Institute students podcast channel. Since 2011, Alla has mentored traders from beginners to institutional Wall Street traders how to trade Alpha Fibonacci system on stocks, futures, Forex, Bitcoin, options, EFTs, and mutual funds. She continues teaching in live online classes, say that fast 5 times, and presents at hedge fund events. So thank you for joining us, Alla. Take it away. I'm going to turn the screen over to you. And if anybody has questions, just make notes and post them up in the questions box, and then we'll get right to them when Alla's done.
Fantastic. And please allow me to share the links to all the attendees. Thank
Yes,
you.
Please share them to me, and then I'll make sure they get posted out. Okay.
Okay. I just sent
All right.
a
Awesome.
couple.
I see it. Okay.
Okay. So
You want
one
me to
second.
send them out now,
need...
or wait until the end?
No, you can post it now. But right now, I'm trying to find the projection. One moment, please. Could you allow this one more time? I don't know where it went.
Yeah. Well, you want me to take it back?
Yeah.
Okay.
Because it flashed and gone, so I can.
Because we can see your screen.
You can see my monitor?
Yep, we can see you're at your home screen, and it looks like a picture of your family.
Yeah, I need to go to a different monitor.
Okay.
So let me stop and let me start.
Yes.
Okay, screen, I found it. Okay,
Yay.
I'm going to the right monitor, yes?
Yes. There we go, how to trade institutional reversals.
Super, and I hear a lot of conversation. There is a man in the background speaking.
I'm going to mute myself, and my husband's on the phone in the other room, so his voice carries a lot. Apologies, everybody.
Fantastic, no problem. And I'm giving you more links. If you could please share for students' podcasts and students' performance. And I'm starting the webinar. Good morning, traders. It's my joy and pleasure being here with you. In this webinar, we'll be teaching you what I teach each and every day to my incredible students, how to trade institutional reversals on all instruments with the Alpha Fibonacci system. But first, I would like to remind you that please understand every single thing I will teach you and show you in this webinar is to educate you and to empower you to trade financial markets. None of it constitutes financial advice. Every single testimonial from every single student believed to be absolutely genuine. No one ever been compensated for testimonials. Please remember to trade with risks you can afford. Understand there are risks involved in trading futures, stocks, and Forex. And please remember, all the software, all the content demonstrated as is without any warranties. This is a required disclaimer. So what we will be discussing in this webinar will be extremely important moments in your trading that will impact the rest of your trading career. You will see Alpha Fibonacci trading system in live markets. You will see how to trade institutional reversals and trend inceptions with Alpha Fibonacci system. We will go over multiple examples, including current today's present market, from day trading futures, long-term position trading stocks, Forex, Bitcoin options, and how Alpha Fibonacci traders trade today and how you can benefit from trading Alpha Fibonacci system institutional reversals, because this is critical part of your trading. Briefly about myself. I hold multiple degrees. I speak multiple languages. I worked at top institutions on the planet. I worked with some of the most brilliant human beings on the planet. By the time I made what turned 30, I made first $1 million. By the time I turned 50, I have a very large family. I have a couple of grandchildren. I believe that time is the most precious commodity in life. When I was introduced first to Fibonacci, I recognized very, very clearly market is Alpha Fibonacci puzzle. I started teaching since 2011 when I founded Fibonacci Trading Institute, Fibonacci Trading YouTube channel where you can see thousands and thousands of video and listen to our members on our podcast channel. I mentor traders at JP Morgan. I mentor traders at Wall Street firms. I teach you how to trade consistently, profitably, with precise rules on any instrument you choose. So here's a system right now in front of you on S&P Mini Future. This is how system identified bullish trend inception on day trading chart as reversal point. Do you see a word reversal zone? Days in advance on March 5th. This is a problem. This is critical resistance. This is where price had been for the last 24 hours. If right now I expand this chart and I will show you, it doesn't matter if you trade 5-minute chart. This is a system in front of you right now in the live markets. You knew this hours, days, weeks in advance. This is your trading range this morning on a top day trading instrument in US. This is S&P Mini Futures. If you can trade this instrument, you can start with one lot size. And if you understand where ultimate reversal points are, where key support levels is, and if you understand that institutions keep buying the markets, You're writing JP Morgan trade with them, not against them. And if I convert this chart to 10 to 15 to any chart you choose to trade, this is the reason I mentor JP Morgan traders. This is the reason I mentor beginner traders. This is the reason you can trade the system, buying ultimate low, selling ultimate high. This is day trading example right now in live markets. And you know this, hours, days, weeks in advance. Here is S&P for the last 14 months with the alpha Fibonacci system. S&P reaching alpha Fibonacci reversal zone. This is January 2020. Many months and years in advance, you know, where ultimate bottom will be. You are not losing sleep. You are not panicking. You understand what identifies institutional reversal with alpha Fibonacci rules. And when market crashes, you are not panicking. If you're trading options, you're trading advantage of the trend inception. And you know, many months in advance, despite panic and negativity, where 2200 critical institutional support will be. March 23rd, worst Thursday in many years. But on the chart, market rallying. On the chart, institutions stepping in with vengeance. You knew this many months in advance. And if you're looking at this chart, what do you see on top? 3930. This is S&P mini futures 12 months ago. What is the difference between March 2020 versus March 2021? This time, institutions keep adding to their positions. This time, institutional support remains respected. You are not shorting the markets in 2021. You are riding JP Morgan Goldman bullish train. You understand the power of trading with institutions and buying institutional bottom time and time again. What identifies institutional bullish rally versus sell-off is the most critical part of your trading. You must understand this every single day. This is how S&P looked like 14 months ago. You knew months and years ahead where institutional reversal will be. And that's a part of your brilliant mind. And that's a part of your strategic trading. And the reason I manage and mentor and work not just with beginner traders, but with hedge fund traders all over the world. If you can trade your micro account with institutions on day trading, you can invest long term. And that's the power of the system I developed in 2008. And this is community of traders, very few photos, but tens of thousands of emails and podcasts on our podcast channel. Sam put his daughter through Harvard trading alpha Fibonacci system. Emmanuel brought his best friend and his wife Jennifer to the course. Richard, you will see his email and journey later. Wolfram invited me to his wedding. Victor, hedge fund manager in Switzerland, trading alpha Fibonacci system on Forex. Michael and Amy trading options. These are very few pictures of traders who using this alpha Fibonacci system lifetime for all platforms or with software for Ninja 8. System consists of only two components, pure price and alpha Fibonacci retracements. You will never, ever need another system again. The core of the system is institutional trend reversal and institutional trend inception on futures, stocks, forex, mutual funds, ETFs, and Bitcoin. So this is what plays out with my students every single day. Every single trader shares. My goodness, Richard shares Bama. I missed a major move this morning, only got 12 points on ES only. If you understand anything about markets, you know this is a lot. Braulia, Edna, and Jennifer supporting Richard. Richard shares how he grown his account. As I posted link in the room, listen to Richard's podcast. You will see much more next. Ken, trading Bitcoin and options, 156 for 156 trades. Currently in 2 long-term trades on OMG and ETH. Jennifer, Emmanuel's wife, says, it's so possible it's almost ridiculous. This is how simple system is. Pure price and alpha Fibonacci strategies only. Ken shares very big, very powerful words. Every trader, different background. Listen to the podcasts on website. If these traders can do it, so can you. With the power of institutional reversals, buying the bottom, selling the top, with alpha Fibonacci system. You know in advance institutional reversals. You know in advance institutional entry points. What would your day trading and position trading look like if you knew this ahead? Here's a reminder of the events of historical week in the markets, March 2020. Key alpha Fibonacci support respected March 8th. This is S&P mini futures and Dow futures exactly a year ago. Trading halted, but on your charts, market rallying. How is it possible? Key alpha Fibonacci support respected. Price remains stuck in this area for the next 3 days. You knew this days in advance. Market keeps rallying thousands of points between these levels. You know days in advance where ultimate bottom will be. This is what starts playing out on March 13th, March 15th, March 16th, March 17th. Institutions start taking positions. Institutions buying the bottom. But there is no good news. On the news, only panic and negativity. What would your account look like if you shorted the market based on the news? Panic and negativity only, but market is rallying, skyrocketing. This is a market exactly 12 months ago. This is institutional bottom. You understand a trade as institutional trader does. You're not listening to panic. You're not listening to negativity. If you know months and years ahead, where institutions taking positions, you're spending very little time in front of the screen. You obey the rules and absolutely taking position with institutions, never, ever, ever against them. And that S&P mini futures and Dow in front of you right now and since the last year. So now I'm bringing up to your attention charts in the live markets on Dow. We looked on S&P. Here is Dow now. It's a vertical bullish rally. It's the biggest rally in 40 years, despite worst economic crisis. Do you remember what the market looked like? Do you? This is what your trading is all about. Understanding where institutions taking positions, buying with them at key institutional entry points. Institutions holding longs, institutions not closing positions. This is your most important chart. This is what your trading should start with every single day. And this is the market right now in front of you. Key support obeyed. Institutions not shorting the market, but in front of you critical day trading resistance. If you view the video, will be posted later today on the YouTube channel. What did we identify with my incredible traders this morning? This is key support. You do not short. Your only option to buy from. This was Dow 3 hours ago. This is Dow now. 32,680 versus 32,897. And that's S&P mini futures for the last 14 months with institutional reversals during the worst market conditions. The Alpha Fibonacci trading system guides traders to trade markets only with institutions as a strategic Alpha Fibonacci trading chess on all instruments. We reviewed markets from this morning, and you will see much more examples next. This is S&P mini future this morning from 39.66. This is precise entry, precise stop, precise target. You will never need anything else. You don't need delayed indicators. You need only pure price. And if you do, you can do exact same thing on anything you choose. This is Richard sharing in his podcast, in his journey, in his emails. When he came to the bootcamp last year in November, first he doubled his demo, and on December 7th, he started trading live with $3,600 account. Within a couple of weeks, he grew his account to 11,575. He produced his best week, making 6,750 per week, which is 4 times of what he was making while working as a physical therapist. His last update, February 24th, he grew his account to 18,500. 423. This is a life-changing event. Richard trades institutional reversals, obeying all the rules of the Alpha Fibonacci system. This is Dow this morning. This is what played out in our trading room. You are looking at key support levels. You are looking at key buy points, and you're looking at the most crucial pink line. When we witnessed the pullback in the trading room, this was a key moment on Dow. And Dow sold off from institutional key ultimate high. All recorded on video will be posted on our YouTube channel. But here's identical Alpha Fibonacci system on Apple. Apple respecting critical support, exact same thing as Dow had done this morning, correct? Exact same thing as S&P had done on any and every chart. But Apple comes out with the worst earnings in 13 years. So how is it possible that Apple doubles in value 2 years later? Many months in advance, you know where reversal zone will be. And when Apple reaches reversal zone, look at the bottom. What do you know? Where will ultimate bullish trend inception will be? 140 level. When key institutional support is broken on Apple and Apple in free fall, you are very well prepared in buying the bottom. All identified months and years ahead. So if you want to day trade the system, of course you can. And if you're trading pure price with Alpha Fibonacci rules, you can day trade futures. You can position trade stocks. You learn your lesson clearly during crisis. Panic and negativity owned by top 1%. Top 1% holding longs in these markets. Real estate in Miami and Hamptons is booming. Biggest parties on the planet in St. Bart's. It started at institutional bottom on every single future, as you will see much more next. Exact same thing happened on Apple during negative earnings, but Apple much more than doubled. Ken chooses to trade Bitcoin. Ken doesn't have time to day trade. Movie maker in London, nothing happening. 4 children views a movie he has made about his life on our homepage. Ken loves Bitcoin. Ken loves options. He just sent me another email yesterday again. Day trading not his cup of tea. He only interested in long-term stocks and Bitcoin, which he can do while making movies. Every trader can decide what trader wants to trade. Is it 1? Is it 5? Is it 15 minutes? Is it S&P? Is it NQ? Is it Dow? Is it Bitcoin? Is it Euro? Is it Pound? Is it Apple? What would you like to trade is absolutely your choice. The skies are the limit. Here's oil traders. For the last 4 years, 2 today. Do you remember oil at the bottom? Do you remember oil at 30, 2016? You're taking positions on multiple stocks. If you cannot trade options on oil future or you day trade oil future, of course you can. So when oil picking up this steam, 2 years later, doubles in value, you know many months ahead where oil will crash from with high 80% success rate. You're obeying the rules, and when oil starts selling off, you're not surprised. 64 is key support. You understand if oil will crash. Oil heading very, very low, pointing to 10 and less. Remember on futures, contracts change. So when Apple oil in free fall, as Apple has done, 55 is a final critical support. Apple respected this support. S&P and Dow respected this support this morning. Oil crushes oil in free fall. Let's push 2 years forward, shall we? This is oil in the last 10 months. Sell-off in progress. With ultimate precision, you know. 15 is out, oil pointing to 0, and negative numbers. Have you ever seen anything like it? Negative numbers on oil? It's not possible. It does not exist. Correct? So when oil skyrockets from ultimate bottom, you're buying oil stocks at ultimate bottom. That's the ultimate way to trade and invest. You understand the rules. You understand how critical this level is. Do you remember exact same thing 5 years before? Price action keep doing exact same thing. This is oil now from negative number. This is the power of the system. This is a reason why not just beginner traders trading the system. This is a reason hedge fund managers trading the system. Ultimate top, ultimate bottom. Here's an email from my dear student in Saudi Arabia. Richard in Texas, Mustafa in Saudi Arabia, Ken in London. Choice is yours. What you want to trade. Is it S&P? Is it Dow? Is it futures? Is it stocks? Is it Forex next? You decide. It's your choice. The Alpha Fibonacci system benefits trader who trades at key institutional levels and spends very little time trading. Alpha Fibonacci trader does not spend endless hours in front of the screen. Never, ever, ever. What would your trading be like if you traded with institutional trend reversals and institutional trend inceptions? Ask yourself that question. Carlton tried for 20 plus years. Carlton is healthcare executive. He trading in the evening and trades for hedge fund. Carlton brought his best friend to the course. Carlton trading S&P mini futures. Carlton based in Florida. Carlton very different than Richard, than Ken, than Mustafa. Listen to the podcast and do exact same thing every single one of the traders does. Every single day identify institutional trend reversals, institutional entry points prior to placing a trade. Successful trader trades only with institutions, never, ever, ever against them. What would your trading look like if you did that? This is my traders at institutional levels. Every trader different instrument. Leslie Rapp trading Dow, Brad trading S&P, Emmanuel Nasdaq, Scott shares as a hedge fund manager trading Bitcoin, trading options, trading stocks. Jean trading options on multiple instruments. And that's the power of our global community. View and see what traders share and what emails I receive each and every day for the last 10 years. This is what traders trade. Another example of S&P mini future. No speculation here, pure price for entry and alpha Fibonacci for exits. Here is Amazon for the last 5 years with alpha Fibonacci system. Amazon, bullish rally in progress. What do you see ahead? Reversal zone. Amazon does not have bad earnings. Amazon selling off. When reversal zone is reached, you know this many months ahead. Amazon selling off $700 per share. And when Amazon reaches this level again and selling off again and rallying from institutional bottom, you are not surprised. Time and time again. All precise, all in advance. No speculation here. None are present. Critical key rules. Exact the same as in day trading, as on S&P, on Dow, on oil, on any instrument. And that's what Jennifer and Emmanuel trades. Nasdaq is what they love. Despite having 2 little babies at home, despite some of the most challenging market conditions on record, mom of 2 little babies and husband with their best friend. It's a family affair. It's a power of our community of traders. Second key step, obey the rules. There is no speculation here. Alpha Fibonacci system has precise entry, precise stop, precise target. What would your trading be like if you traded with rules? No speculation here. So Andy is a hedge fund manager in London. Andy trading Alpha Fibonacci system long term. And when he introduced his son Dominic to the course, wait till you see what played out. And that's our community. And that's how traders inspire each other. This is Andy's email to me. Hedge fund manager introducing his son, Dominic. Dominic sending me an email. This is what he does during crisis. Guess what I'm doing this afternoon? I'm mentoring 11-year-old girl, daughter of my other trader. This shows you the simplicity of the system, traded globally for the last 10 years. 11-year-old Emma will be competing against Dominic. And that's the power of institutional reversals, pure price for entry with alpha Fibonacci rules. Listen to podcasts because this is what traders trade globally. You will never, ever need anything else. And that's from Scott from Hedge Fund Trader. And that's key part of your trading. Trade institutional reversals only. And if you want to trade on stocks, of course you can. If you want to trade on Bitcoin, of course you can. Choice is yours. We already reviewed oil. We already reviewed S&P, Dow, futures, Amazon, Apple. Third key step, Identify your trading range prior to placing a trade. Everyday trading range will vary. It will never, ever, ever be the same day. It is very, very different day when institutions acquiring positions versus not. It is essential you understand and trade as institutional trader does, no matter how small, no matter how large your account is. And that's what played out at a very difficult trading range. So if my traders can manage very difficult trading ranges, imagine what you can do. Simply identify what's appropriate for you. Gold future in front of you. Day trading. Simple. There is no complications here. Pure price for entry and alpha Fibonacci for exits. Let's look on gold long term, shall we? Let me find the chart. One moment, please. As we have hedge fund manager in the course who trades gold long term. So this is a day trading instrument on gold future. Everyone clear on that? So here's gold long term. So if you invest on gold long term, this is gold chart since 2016. Many years in advance, you understand where reversal zone on gold will be. So when gold starts selling off, you're not surprised. That's the power of the system. Sell off, very, very weak key support respected. And when reversal zone identified, many years in advance finally reached, on long-term chart, what is intelligent trader knows. 1900 holding the key. Gold in free fall. When this key support is out, this is gold right now, this morning. This is your long-term investment positions. You are not panicking. You are not speculating. You absolutely expected sell-off when reversal zone identified many years in advance was reached. There is no speculation here. This is two different charts, monthly and weekly, for the last 4 years to this morning. And it's exact same thing that playing out on Apple, on Amazon, on any instrument you will choose to trade. Here's Amazon right now, stuck in bearish correction. Amazon been sitting here for the last 4 months. Here is Apple. Bright pink line, critical support, sell-off on Apple from 145. This support holding the key on Apple. Tesla, another very powerful instrument. Sitting very pretty at key support. Tesla sold off from 900 to 600 level. You decide. Do you want today or position trade? Choice is yours. And that's Alpha Fibonacci system on day trading versus position trading gold. Brett is a legend. inspiring so many other traders. Brett was making $10 an hour, lost a fortune, tried for 20 years. So listen to podcasts, see the stories, see the journey of other traders. If Brett can do it, if Emmanuel, if Jennifer can do it, if Richard can do it, if Ken can do it, if Carlton can do it, so can you. They simply obey the rules and trade what's appropriate for them and their account. Here's the example on pound. Pound respected the end of the minor trend. When I met in Switzerland with hedge fund manager who trading Forex with Alpha Fibonacci system, what did he know many months and years ahead to monitor reversal zone on pound? Has anybody seen good news in Britain? Of course, there is none. Brexit, panic, COVID, shutdown. So how is it possible that pound skyrocketing? It's a reversal zone. It's ultimate chart. It's ultimate reminder on pound.
Hate to
You
interrupt you, but we're out of time.
Thank you,
Sorry. I'm
traders.
so sorry.
No
Hey,
problem.
I did post your links. Everybody go back to your chat and your questions, and you'll see the links to get everything that Alla has brought here. I mean, this is just mind-blowing. And if you have questions, you just need to go to her link and send a question there. And I mean, so much information here, Alla. Thank you so much. I appreciate it.
Thank you, traders. Any questions? Do not hesitate to contact me. Thank you so much, everyone. Thank you, Sherry. Bye-bye.
Have a great day. Thank you. All right. Now, again, if you need to leave, we do have our webinars that will get posted within a day or two up at tradersexclusive.com and the archived webinars. And you'll be able to see everything back as far as last June, I think. And you'll also be able to see a list of the webinars coming up. Now, our next speaker is Norman Hallett, and he is with The Disciplined Trader. He's going to be talking to us about 4 primary keys of a successful trading plan. Norman Hallett has been trading, a trader and trading educator for over 4 decades. From 1981 to 88, he ran one of the largest options firms in the country and later worked as a commodity specialist for Payne Weber. And in 91, he formed the Hallett Group, managing large trading account for individual investors as a commodity trading advisor. I'm sorry, today I'm just stumbling over myself here, but he currently owns and operates The Disciplined Trader, founded in 2000, where he focuses on helping traders with the too often neglected area of mental and emotional control and the building of simple trading plans. Mr. Hallett is a popular speaker at trading expos and countless international venues. He has over 1 million views of his 4-minute drills for traders, which you can find on YouTube. And he gives tips and techniques for being a more successful trader there as well. So thank you for joining us, Norman, and take it away.
Thank you, Sherry. Every time I listen to Alla, she gives such a soothing presentation that it's amazing. She, a lot of wonderful stuff she has, and but I'm going to wake you up, everybody, a bit here. Trading is a mental and emotional challenge for most people. It really is the reason why most traders fail, no matter how good the trading system is. One trick is to realize that. The other trick is to find a trading plan that fits you. So if you find some of the keys that I give you today as something that seems to fit you, especially in its simplicity, because that's where I'm at. The simpler the trading plan, the less complicated the trading plan, as long as you can back test it and see that it works, the more effective it's going to be for you. You've got to match your own personality really to a trading plan. That's the reason why you can take somebody's trading plan and that's working for them and it doesn't work for you for some reason. And it's because there's a little bit of a conflict there to keep you on track with the plan. So let's get to the presentation today. Please do ask questions if you have. I'm going to try to get to them toward the end. I'm going to give you a link where you can ask questions to me afterwards, because I'm limited to 45 minutes here, which I think, Sherry, is a great idea, because we have to get the good stuff out in a shorter period of time. Time is the most valuable thing we have. I'm going to show you today what I believe are the 4 primary keys of a successful trading plan, no matter where you look. And so first, please grab pen and paper, because I want to make sure that you write down these 4 keys, whether you are attracted to what I'm going to show you in the end in the very few last minutes. I do want you to have the keys so that you can possibly implement them in what you're doing. Okay. I want to show you a 4-step formula that's really working well to stay consistently profitable, so you can develop a steady income or building a long-term wealth strategy, or both. And I find that most traders are trying to do either one: a steady income where they can add to what they're earning, or their retirement income, or if they're younger, they're building a long-term wealth plan. Okay, so I'll wait a second while you grab paper and pencil. In fact, I'll wait 5 seconds and I'll let this machine count it down. Look, imagine this scenario. What if you suddenly found yourself building profit in your trading account month by month, resulting in your best trading year ever in 2021? What if you suddenly woke up every morning excited about trading because you had a trading plan that actually worked for you? And what if all your dreams of financial independence and having your time be your own? Again, time, I find, is the most important asset that the trader has, the gift to themselves. And what if that was actually the life that you were living? And I know that for some of you it sounds like a stretch, especially some of you that have blown through account after account. And I took a poll one time, and about how many accounts traders on my list had blown out before when they first got to me on a presentation. And it was surprising that not the majority, but 43% had blown out 5 accounts or more. So I know that it sounds like a stretch, but simplicity, again, is where you need to concentrate. I used to think it was a stretch too, until I figured out why only 10% of traders were making money while the other 90% were financing that 10%. It's literally those 90% that give the money to the 10%. In the past 4 decades, I've managed professional trading rooms where I've monitored the results of 60 professional traders at a time in separate rooms, 60 by 60 by 60, as I managed different offices. And I saw exactly why some traders produced consistent profits while some couldn't get out of their own way. And I've used the exact same things I'm going to show you to manage millions for well-off investors as a commodity trading advisor. And I used it during my 2 years as a commodity specialist for Payne Weber. And I just recently revealed it to a group of new and experienced traders through my online training. And you may want to be part of that. The thing that allowed all this success is having a simple trading plan with just 4 key parts. Before I get to it, just give me 60 seconds on the 5th key part right here. That's my wife, Tisha. We're having our 40th anniversary in a couple of months. So she's put up with a lot, but she is a subconscious trainer. And it was Tisha who helped reverse my trading fortunes from desolate failure to success, because she taught me the value of being mentally and emotionally strong, and how to do that through subconscious trainings, which is part of what we do also. That's me. I've talked to in many venues. That's actually my own, where we had a down in South Florida a few years back, where we had traders like John Person and others that were presenting. But I've just about met everybody in the trading industry, because the bulk of what I do in the mental and emotional areas are a complement to people like John and others who just sell systems. I've actually integrated the mental and emotional strength into the systems that I build. And that's why I'm so proud of what I'm going to show you today. And this, we do some coaching also for another talk, but that's Tisha on Zoom just about 6 months ago with Chris, working one-on-one on using a process called EFT, called Emotional Freedom Technique. I don't want to get too tinfoil hat for some of you, but understand that the process that she's using with Chris right here is a process that's actually the go-to process for servicemen that come back from the war and have issues. So we use a lot of advanced techniques, and that's what we're famous for, as well as building trading plans. Everybody knows that there are traders who are making money and some are making big money. So what exactly are these 10% of the traders doing that the others aren't doing? From my experience, I can tell you that with authority that those who are making money consistently have paid attention to these 4 primary keys. In fact, there's an overall secret that encompasses the 4 primary keys that actually brings everything together and pulls you really into trading success. And that overall key is probably not what you think. It's not a technical tool. It's not Fibonacci or Bollinger Bands. It's not clouds or candlesticks. It's having the ability to stick to your trading plan without wavering. The ability to stick to your trading plan without wavering. Mental and emotional control. And the best way to do that is to have a simple trading plan with elements that you understand and that you believe in. Okay. Let's get to the 4 primary keys that consistently successful traders make sure their trading plans contain. Primary key number 1 is to keep your losses small. Very small is even better. We've all heard this before, but do we do it? And do we do it consistently? Because many of the traders that I talk to that are having issues and blowing out accounts have that 1 or 2 trades where they do not follow the strict rules, and those are the account crashes. Look, trading is a risk business. If you don't take a risk, you won't have a reward. And the key is to keep that risk small, which doesn't mean that the reward has to be small. The most successful trading plans the most successful trading plans that I've designed, that are overall designed, have at least a 2-to-1 reward to risk ratio. They've designed that into every trade. This way, even if your trading plan has a 55 or 60% successful rate, which a lot of good plans have, you'll be way ahead of the game if you have that 2-to-1 reward to risk. And again, that 1 in the 2-to-1 ratio has to be small, meaning no more than 2% of your total equity should you be risking on any trade. And I usually try to keep it to 1, okay? And I'm talking about 2% of the total equity in your trading account. And again, 1 or 1.5% is even better. Why? Because when you keep your risk small, you ratchet down your stress level and you'll be able to stick to your trading plan without wavering. So keep the risk small, which brings us to key number 2. Take what the market gives you. Now, take what the market gives you is the rallying cry for scalpers. And I know some very good scalpers out there. I think so Sherry knows Marina down in Guatemala, who does some teaching. She's a terrific scalper. She makes some really nice money, and she's a great teacher. Scalpers can do well. You take what the market gives you. If you don't ask much from the market, you'll be able to take more profit more of the time, okay? Just keep putting those small gains in your pocket, and they add up. It just makes sense until you start looking at all the profit you left on the table when a market decides to run and you got out way too soon, okay? That's the mental problem with taking on a purely scalping approach. And this feeling of I should have stayed in starts gnawing at you, and you get pulled off your trading plan, which is not good. You start over trading to try to get back some of that money you left on the fictitious table. And that leads us to primary key number 3, let the market run. Wait a second. How can one key be to take a short profit, aka take what the market gives you, and another be to let the market run. The answer is have both of them in your trading plan. I'm going to let that sink in for a second. Have both, let the market run and take the low-hanging fruit in your trading plan. Have both in your trading plan. You see, if your trading plan if your plan accounts for only let the profits run, then you'll have to leave room for it to run. And by room, I mean room to pull back during a run. No run goes straight up. And when the market pulls back, it may actually be reversing, giving back most or all of your gains, sometimes falling into a losing trade when you had a big winner, resulting in you saying to yourself, why didn't I just take what the market gave me? Okay, so this can result in revenge trading. And you try to get back what you gave up, leading to, well, you know, big problems, big losses, blown out accounts. It's hard to control yourself when you have a plan that only let markets run. Markets come back in a correction that winds up to be a reversal, and boom, your mind gnaws at you that why don't you just take a little bit of the profit that was right in front of you. Some of the most successful trading plans I've ever seen have both the ability to take a short profit and let the market run. And to do this, you must initiate your positions with multiple contracts. Now, if you're trading futures or forex or options, that means a minimum of 2 contracts. That would be multiple contracts. And if you trade stocks, that means, say, 2 lots of 100 shares or 2 lots of 50 shares, whatever is your capability. You see, by following both keys, you'll stick to your plan knowing that you've accounted for what the market gives you and the chance to grab a windfall if the market runs. Because in the end, the 10% of consistently successful traders have a plan they can believe in and follow without wavering. And this is the type of plan that I have found that traders can follow without wavering. By having both keys in your trading plan, you take the questions and doubts out of your mind. No more chasing markets because you got out too soon. No more beating yourself up because you should have taken the easy money. From here on in, I'd like you to consider planning for both, having a plan for both. And that gets us right to the final key of number 4, which is the high probability trigger. Now, I'm going pretty fast. In 15 minutes, I've covered the first 3. I'm going to show you a bunch of examples. And but first I need to describe one of my favorite high probability triggers to trigger you into a trade. You can call it what you want, a high probability trigger, whatever you want, getting off on the right foot, giving yourself a head start, but whatever you call it, it means that when you enter a trade, you're going to do it with a high probability of winning, okay? And how do you know that a trigger has a high probability of winning? You conceive it with technical logic, and I'm going to show you a little bit of that, and then you test it. Okay, in fact, here it is. I'm going to show you a high probability trigger, and this is a high probability trigger. I think I said that right after the 3rd time. It's been tested by me and by a couple of 100 traders who are trading a particular trading plan I'm going to show you, who are now using it in a simple trading plan that I created. Here is the trigger. And I hope you can see this arrow, but in case you can't, I will just describe the first candle here, the one with the red in it, and the second candle. If you're unfamiliar with candles, let me look at the green one first. This candle, I'll just briefly describe it. The body of the candle is this square. The vertical here is the price action. Price, high price, low price. And the body of the candle, which is this green, denotes the open and the close. The market opened down here at this price and closed at this price during this candle's lifetime. And this candle's lifetime could be any lifetime, 60 minutes, 240 minutes, 5 minute. I know some people that trade 1 minute charts where each candle is 1 minute. So let's talk about a 10-minute candle, which I like to talk about. These wicks of the candle are trades that occurred during that 10-minute period outside of the open and closing range. What you can't tell about this is how it happened. The market, we know the market opened here and closed here. But during that 10-minute period, it could have shot up here, gone down here, up here, down here, down here. Could have done anything during this 10-minute period. But the Japanese, I believe it was almost 500 years ago, that the Japanese farmers that created the candlestick, the candlestick process, give credibility only to the open and close. They believe that during all the noise between that period of time is just noise. The only important thing is where the market started out and where it ended. This is right here a smaller candle on the left. This is a spinner. There are two definitions. A spinner is a candle with a very small body like this, say 1 or 2 ticks. Vertical ticks in price, and if the open and the close are the same, this would not even be a color; it would be a line, and then this candle would be called a doji. The important thing about a doji and a spinner, and when I talk about a spinner in the trading plan I'm about to show you, I'm talking about a maximum of 4 to 6 ticks from open to close. So I don't want the spinner to be very big, and I'm going to show you a few examples. The perfect example of what I'm about to talk about is a doji, where the open and close are the same. This spinner, and ideally a doji, is an example of indecision. During this 10-minute period of time, the market didn't know where to go. The market was undecisive or indecisive. It opened here at the bottom here, at the bottom of the small body. It traded during this 10-minute period in this price range and ended almost where it opened. During this 10-minute period, traders could not decide on where to take this market. Now, I will tell you from experience on the trading floor that there are lulls. There were lulls years ago when there were trading floors with traders on each side of this, usually a semicircle. And what happens is it gets very quiet, and traders are looking at their sheets and looking at their charts, and nothing's happening. And this is usually what's happening. Then all of a sudden the market picks up. The market starts to go higher and breaks the high of the previous candle, inciting some systems to want to be buyers. And all of a sudden, anybody who was short during this period or before, they're starting to lose money. They start to buy to cover their short positions, and they add to the rally that's happening here in this bar. So what I'm looking for in this trigger, okay, the logic behind this trigger is we have indecision followed by a decisive candle. And what happened in this decisive candle is we had a number of people that were short before this, and they are losing. Okay, this pushes the market higher. This now, the market has decided on a short-term direction. Okay, this is a high probability trigger. Okay, let's take a look at what that high probability trigger looks like in a chart. Now, in a simple trading plan, I never use more than 2, sometimes 3, if you push me, indicators in order to trigger into a trade. In the case of this trading plan, this is a moving average, and it's a specific moving average that we use. And the moving average, some use a little bit different moving average. Some may use a 10, an 8, a 9. Moving average, some may use exponential. I have, for my systems, a particular choice that I've learned to use over the years. But here's the exponential moving average that I use, and here is a trigger right here. Now, this indecision bar followed by a decisive bar. Now, it doesn't look very big, this decisive bar, but it is a bar that has moved from one side of this exponential moving average to the other. And what I look at, I'm looking for 4 times. I want this body, the extensive body, to be at least 4 times the size of the indecision body. Okay. Now, if you have a doji where the price is the same and this is just a line, then 1 tick would be larger than the body here. So there are other small rules there, but the idea is that you want to see a small body and an extension through the exponential, through this short exponential moving average. Okay. And what you do, you buy once that you wait for the close, because I've seen markets in the last few seconds come right back down with reports coming out and whatever. You never know. With our last president, you really never know what time a statement or a tweet would come out. So you always wait till the close of this bar, and the next bar, the first moment that this closes, I always have my finger on the mouse. 48, 58, 59, boom, 60. I'm clicking it, and I'm buying on the first tick of the next bar. And right after I buy, and I'm buying again 2 positions. I always buy 2 positions. Once, so I'm looking for indecision, a breakthrough this exponential moving average. I buy 2 right here. Then the next thing I do is I put my stop right below the tick. Some people like to put 2 or 3 ticks. That's a matter of fashion, but I usually put just 1 tick below whichever of the 2 bars are lowest, and I do include the wicks in that. So I wait for this to end. I buy 2 positions. I put a sell stop into to sell 2 at the market, a tick below, and then the next thing I do is I put in my scalp limit. I measure the size of this body. I extend the size of that body from the close of the body. So if this is 10 ticks, 10 tick body, I'm extending from the top of the body here, and I'm very exact about this. And I put it right here, 10 ticks above. I'm putting my limit sell to sell 1 of my positions. Okay, remember, I always take on 2 positions, multiple positions. Okay, then in this particular case, when the market moves higher, right around this area, one of these 2 candles, it's going to hit my limit. As soon as I sell that limit, and take my scalp profit, I move my stop, my remaining stop from break even. I change it from 2 positions to 1, and I put it at break even in this area, in that area right there, where I bought. So that is the process. Now, I cannot go into the exit process, which is just as important, except for to say, if you get a reversal signal like this, you'd be exiting. Okay, but there are rules that we have, and they're simple rules in order to get you out, because getting out really is the other important half of the game. But I wanted to talk today about triggering, and I wanted to again mention the idea of having 2 positions so that you can take a scalp and let it run. In this particular case, the market went back down, and it looks like since I took my profit here, because this is a reversal signal. Look what's happening here. You have a indecision on and the next candle is a powerful candle through. Now you got to measure your risk. 2 positions, and here would be the stop to see if this is a trade that you can take that's within your range of risk. You don't want to go over 2%, and again, you want to try to get 1 and 1.5%. But if it is, you would be selling 3 here actually, because you'd be taking your profit on here. Okay, because it didn't come down low enough to hit the break-even stop. So you made a little bit of money on that second position, and now you're short 2 here. Put the stop to buy 2 above here, whichever is higher, okay, and put your limit sell to buy right here, the scalp position, okay. Market came down within the next 10 minutes. This is a 10-minute chart, I believe. Within the 10-minute chart, that's pretty big. Pretty big lot writing there. 10-minute chart, you take your profit here on your first position, you move your stop to break even, and then you let the market run. Now in our position, we would actually be taking our second position out here. There are some rules about being far from the moving average, but again, there are many rules, and they're very important. Otherwise, you won't be able to run the system based on what I'm telling you right here. But I just wanted to show you the effectiveness of the trigger. So in this particular case, here's a losing trade. Okay, here's a losing trade that would have been a total loser. So make sure that when you measure this trade, you that it's within your risk parameters. However, in this particular, it wouldn't have been a total loser because you had a reversal pattern right here. You would have bought both. You would have actually bought 4 here. Remember, you sold 2 here. You never got to take your scalp. And 2 10-minute sessions later, 20 minutes later, this market closed back above with another trigger. So you buy 4 here, which means you took a loss on 2 positions from here to here, and then you buy. You've got 2 here that are going to remain. As soon as you do that, you put your stop in down here below the low of the 2 bars. You put your your sell limit here. Again, you're measuring this body and you're taking your scalp at that point, and you let it. And then once that's hit, you move your stop to break even on the remaining position, and you move higher. Okay, so you can see right here how effective this system. Here you would have had a nice big winner. Here you would have had a nice winner. Here you would have had a nice winner. Here you would have had a loser, and it could have. It almost was a maximum loser, but it had a reversal signal. Now, this is rare that we're getting so many reversals, so many triggers in the same chart. But I used it to show you. Generally, there are other features that you need to know in order to get out, so that you limit your loss on or maintain the profit that you have. But let's go on. Here's the euro dollar. Okay, I'm just going to watch my time here. Here's the euro dollar. You can see here. Of course, I started it at a convenient place, so I look like a genius. But the idea is that if you care to try this system, that I think you're going to want to. I have a guarantee that has you back test it for 60 days and see how well it works. I'm not going. So here is a beautiful signal, right? A very small body with a move through, and look at this move. Our system, let me look closely here, would have had us stay in this. We still would have been in this with our rules, and we would have been out right in this area of the second position. Again, the first position, we would have taken the scalp here, okay? Now, those with big money and want to take on 3 positions here, they would take their first scalp here and a second scalp here, for instance, a second measure of this body, first measure, first scalp taken, second measure, second scalp taken. So there are some variations depending on how big your account is, or if you're trading the micro minis in the gold and the S&P, those in $10,000 accounts. Many times, if on something like this, on something like this, if it was a micro mini, this is a euro contract, but the risk would be small enough to actually take 3 contracts if you wish to. But always start out with the minimum when you're starting to use a system. Here's another one. We had a nice run here. The scalp was taken here. Market went higher until we actually would have been out on the reversal here. And now here's something interesting. I guess I'll as long as it closes above, it's important that the first part of the trigger be on one side and the extension go through the moving average. And here, the fact that we closed above this moving average and came down through it and had our trigger, that was a valid. If this spinner was closed below, this would not have been a signal. Just to give you a little nuance, and I love nuances. Again, here's a movement here, movement. Again, this is, let's see, this is Zoom, which did very well with Zoom. Works with Forex, it works with stocks, it works with commodities. Again, the idea of having indecision followed by decision. So here's another secondary move here. Here's one right here that actually, now when you're dealing with stocks, market closes and opens. So there are a couple of different rules there, but the same thing applies. Really, in the base theory applies. Indecision followed by decision through the exponential moving average, and boom, you'll have a nice little trade here. And this is one that my wife asked me to trade, and so we did, and did pretty well in buying tech. This is the Pfizer partner for the. Here was one. It's very small, but it was 4 times. Here is very small. Had a nice move here. Here is a big move here. We didn't actually take this because the account we were trading this in and the amounts we were trading were not small enough. But if one had a big enough account, they would take it here. Here's another nice move. So it works nicely in stocks too. Here's another stock, overstock. You may want to take a look at that if you want a stock that deals with the Bitcoin market, but indirectly, but very much so. So overstock, I wanted to make sure I gave you that for you Bitcoin fans. So let's review the four primary keys to put yourself in the 10% club. Keep your losses small. Take what the market gives you. Let the markets run. Okay, so losses small. Take what the market gives you. Let the markets run, and use a high probability trigger. That's all I've done here, and you can see the process of winning here and how well it does. And I didn't cherry pick stocks here. I think, or charts of any kind, or I trade basically commodities, but I didn't cherry pick. You can take a look at any chart and you'll see they may not be as frequent as these. I use charts that had frequent signals, but when they happen, they're very effective. But you got to know how to get out, okay? Because that's important. But if you have processes to get out, you may be able to use this in your trading plan. What I've just given you is an overview, an exact trading, simple trading plan that I'd like you to own and try for yourself, because I want you to experience the same success that other owners are having. And in this trading plan, it's called Loaded Gun, and it's called Loaded Gun because of the trigger. It looks like my wife hates this name, but I couldn't change it because this trading plan took off right when I first introduced it, and so I couldn't change the name. It looks like a trading plan that's I'm sorry for that. It looks like a trading plan that, or a gun that has a trigger here and the barrel pointing upwards. So that's why it was called Loaded Gun. This simple trading plan called Loaded Gun has that technically logical high probability trigger that I showed you that gives you a head start on profitable trades. It gives you clear rules on how to keep your risk low, very low, so that you can move past any unsuccessful trades with ease and move on to trades that are money makers. In this simple trading plan, you'll pocket the low-hanging fruit, and you'll also be allowing the profits to run and possibly have a big windfall. I'm going to show you one that happened today. So you're not chasing trades, you're not revenge trading, you're not screaming. I bring this up because this is the bane of traders. This is where they really go wrong. They have a trading plan that they're just unsure of, and they haven't, and it doesn't give them consistent enough results, and those doubts lead to not following the plan, chasing trades, revenge trading, screaming at yourself for not taking a profit when you had it. Just imagine finally having a simple, logically derived plan that'll lead to financial independence, where you go where you want, do what you want, because your time is your own. And this is what the simple trading plan looks like when you, if you were to try it. This is where you'd log in and see. These are videos that describe the simple trading plan and its rules. In fact, it's a simple trading plan because everything fits on one sheet of paper, and not even the whole sheet of paper, about half of it. The rules are simple, and you'll be able to download a copy of it and learn the trading plan from the videos here. Then there are nuances. I mentioned that I love nuances because every trader is different. Some traders are ADD, they need trades all the time. I can show you how to nuance the trading plan so that it fits you a little bit better. Some traders who are usually the best traders are the ones with patience. It's the asset, that mental and emotional asset, that we find is the most valuable for traders, waiting for the trading plan to evolve. Let the market, let the bar close. Wait until the bar closes, and then take the trigger when it gives it to you without hesitating. These nuances will help to actually, there are 7 major nuances that you can not use or just use the regular plan, but I like nuances so that they fit your personality. Then we meet every month and we take those get-togethers. We show my age. We video those. We put it on cassette. We send it to you. We put it on. We were all in Zoom in our little boxes, and we share our successes and our questions. Okay, simple trading plan. It's $7.97. But Anna, who works with us, she made me give you. Well, I had a discount in mind, but she made me increase it for those who attend this presentation. $300 off. Okay, $300 off, so that your investment for this simple trading plan, to try it for 60 days, that honors all these 4 keys I've gone over and much more, $497 for you. And if you prefer, I've even given you a 3 easy pay option. Okay, I set up the option so that even the smaller accounts can get, because this works great in the micro minis accounts and for small option and not small options, and if you're only trading 10 shares of stock at a time. Look, if you have a solid trading plan, smaller accounts become larger accounts. So you wouldn't be the first. So to build a large account from a small account, you just have to have a doable process. So why not you? And I want you to try it at no risk. And just like this plan is simple, I'm going to give you a simple guarantee. Full 60 days to back test the plan, to attend some of the meetings that we have, to talk to other traders that are using it, and then trade on in simulation, trade it with real money. Do whatever you want to in those 60 days. Try it for 2 months. And if it's not the plan for you, just email me and I'll refund your money. You don't need a reason. The risk is mine. And I forgot the bonus. I didn't. I put it in. I just put this in, so I didn't really forget it. But I forgot to tell you, but I'm telling you now. I'll throw in a 30-minute one-on-one Zoom session with me where we'll go over any questions. I want to hear about you, how you trade, and I want to show you maybe some of those nuances that'll even make it better. I want you to look at the basic videos, learn the simple system, and then I want to interview you. You and I will talk together, and I'll show you how to make the trading plan even more like you. And this way, you'll fully understand the power and consistency of the plan. And you can go ahead and start experiencing what it's like to be part of that 10% that take from the other 90%. I'm not sure. These are testimonials. And, you know, the thing about testimonials, I have testimonials is that they can give you a testimonial one day and then all of a sudden they stop winning. But they never give you the I want to close my account testimonials. These testimonials have stuck, but, you know, they're testimonials. I want you to experience it for yourself, okay? You have to act fast because this is only good for a couple of hours. I find that people who are, in fact, it's only good for about an hour and a half. I find people who make decisions that they know it's for them. They know they want to try it. These are the people that succeed. So I don't want to, you know, tantalize anybody else that it may not be for. If you feel it's for you, give it a shot, okay? Remember, the risk is all mine. Here's the link, simpletradingplans.com/Anna, okay? I put Anna in there because she's giving you that extra $100 off. simpletradingplans/Anna. And again, the formal personal guarantee, if after using this powerful simple trading plan, loaded gun for up to 60 days, and you don't think it's worth 5 times what you paid, I'll refund your purchase. No questions asked, okay? And I'll be waiting. In fact, when this is closed, I'll be in that. You know how they have the little chat on the lower right-hand corner of a site that you're at? I have one of those. I'll be manning it. If you've got questions that you weren't able to ask here, because the 15 minutes I usually take questions at the end, I'm not doing right now. But if you have questions, go to simpletradingplans.com/Anna. If you go without the Anna, it's a $797 deal. If you go to /Anna, it's going to be $497. Okay, so I'll be waiting for you in that chat box. I'll be manning it myself, not Paul or anybody, my assistants. I will do it myself. Okay, here is a testimonial. Here are those completed trades. Again, we always share from earlier case. I wanted to show you that loaded gun works for FX too. He's a heavy FX trader. Here's somebody who I rescued from the brink. But, you know, again, you know, all of this is hyperbole. Everybody has their own situations. Virginia Davis, you know, so the reason I'm writing you is to let you know that what you've taught me has transformed my life. Look, every successful trading teacher has testimonials like this, but it's got to fit you, which is why I give you the guarantee. Okay, simpletradingplans.com/Anna. But I want to show you what happened today in the system because I'm a big gold and silver trader. I think silver's going, and I want to show you this. This is silver today, okay? And I want to. This is the 10-minute chart of silver. It didn't give it to you in the 10, but look at the 60, and I teach you to look at different time frames. Look at this right here. I guess it was easier to see before, but here it is. Here is our signal. Here's a losing signal beforehand, but here is a signal that got you into a tremendous trade today. Okay. Here's another. Let's see. Yep. Here's a signal right here that got you into the scalp, but break even on the other. Here's another signal. See this? here's a short loser, and here's a signal that got you in, and you rode it all the way up to this reversal signal. So you took a nice, not only did you get a nice scalp, but you got an equal sized runner. The scalp wound up to be as big as the runner because of the body here. And here you got a nice movement down all the way down here. Here you had another run right here. Look at this signal right here. Here was a losing signal, but followed by a huge winner, okay? This is not a signal because this is actually a signal, but you got your scalp. And here's another signal. If you had it, you probably wouldn't take it because but it didn't wind up working out anyway, but the risk may have been too big. Okay, I think my time is up. I wanted to, again, make sure that you saw the link, simpletradingplans.com/Anna.
I put it in the chat a couple of times. I did.
Okay. I know you're relentless, Sherry, and I know that you're.
I am relentless. It's almost time. It's 3:59 where I am. You guys everybody stuck with us for a lot today. A lot of information here today. I really appreciate you joining us, Norman.
Well, they know they know the quality. That's my assistant telling me it's 4 o'clock. They know the quality of people you bring, and I'm not self-serving myself. You know, when I have a good serve and somebody gives me a good return, I always compliment them on the return. It's kind of like complimenting myself on a great serve. But you always have quality people. You know, there's a lot of people doing this right now. All these people, 4, 5 people, 10 people talking. Your people are always great. So I'm always honored to be here with you.
Oh, I'm glad to hear that because we'll love to have you back again.
Anyway, I got to call Wally.
All right. So, guys, avail yourself of that simpletradingplans.com/Anna. It's a great deal. Thank you so much for being with us today. And let me just grab here. I got one last slide to share. And I just want to remind you that we will have a replay up. And when you go there, you can scroll right down through all of the previous webinars. And that will be our presentation today. I want to thank everyone for coming. You can find us on twitter.com/options_info, tradersexclusive.com. And this is your host, Sherry, and I'm just hoping that everybody trades well. Bye-bye now.